when it comes to Treasury, we would get a more conventional pick because Trump does care about who is going to be the leading voice, especially for financial markets. If it does come down to Howard Lutnick and Scott Bessent, who do you think the financial markets would like to see?
I think either one of them would be a welcome pick. But I'm in the same position as you are in speculating as to which one is more likely. The challenge, I think, with Scott Bessent is that he might be perceived as not fully on board with the very significant tariff policy that's coming down and the use of tariffs as a sort of as a bludgeon that's coming down the pike right now, because that is absolutely where President Trump is. And if you see a Treasury Secretary walking that back in the running for the job, I'm not sure that's going to play to his advantage.
Well, he might need to regulate Bob Lighthizer, Ambassador Lighthizer, somewhere in the administration. Where do you think Trump would be placing him?
So I think, he will certainly play a prominent role. He's the key behind the scenes on crafting the tariff policy and trade policy for the president. And if he has sort of a general senior cross-agency platform on trade, then that puts him in a powerful position. But also, he won't have all of the resources of, say, an agency that he would govern directly, like USTR or the Treasury Department. So it does also come down to sort of who has authority, who has resources in those positions. But he certainly, he will be Trump thinks of deals, and on deals you have lawyers, and Bob Lighthizer is sort of the chief lawyer on all of the deals that Trump plans to do using tariffs.
Heidi, you mentioned some of the more surprising picks from Donald Trump for his cabinet, and including ones like Gates that's polarizing even within the Republican Party. What do you think the confirmation process is going to look like? How easy or difficult will it be to get some of these nominees through?
Look, I think this is a huge loyalty test to the Senate and to the incoming to Senator Thune and the incoming Republican leadership. This is, the Senate has a serious advice and consent role that's meant to check the balance of the presidency, and it's something. It's in the Constitution. Trump has asked for as a loyalty test for the Republican Senate to basically bypass this process and just use recess appointments, so there would not be confirmations. And I think that is going to be extremely, extremely difficult. We have a lot of. Sorry, go ahead. There's a lot of attention on Matt Gaetz. For very good reason. He's super controversial. He took down Kevin McCarthy. I think there's a very big chance you're going to see a lot of leaks around a Gaetz nomination. And Tulsi Gabbard, that's a risky choice. It's a risky foreign policy choice because she doesn't have the intelligence background, and if going
to be some tight decisions to make, Heidi. We're just coming up against commercial breaks. We've got to run. Heidi Krieger-Rediker there, the Council on Foreign Relations. Thank you from New York. This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
So in 60 minutes' time, we'll get some PPI data for you and jobless claims as well. In 2 hours' time, we've got the opening bell. Equity futures right now on the S&P 500 higher by 1/10%. With some morning movers, here's Manus Cranny. Morning, Manus.
Jonathan, very good morning to you. Two very different sets of guidance. Let's dig into the Cisco guidance. First of all, a little bit lighter than the market would have liked. They're going to make 55.3 to 56.3. That is lower than the estimates. They're battling inventory buildup and slower government contracts. When it comes to, of course, the magic words, sprinkle dust, AI, Chuck Robbins say infrastructure is going to make it made $300 billion in this quarter. It's going to make $1 billion in 2024. So that's the magic of AI to come. A different set of guidance. This time, Bob Iger trying to sprinkle a little bit of a whole new world over at Disney. High single-digit adjusted earnings per share growth 2025. They don't typically give guidance. They've given for 25, 26, and 27. You're seeing double-digit growth in the entertainment business, some cracking movies, Inside Out, Deadpool, and Wolverine. So that helped them there. Experiences, it's interesting. You know, think of the theme parks. Tough time. Paris Olympics was on. Two massive destructive hurricanes, Helene and Milton. So that just gives you a flat number there. But I go to the New York Times, stunning line on linear TV. It's atrophying, income down 38%. The deal, Lena Khan, she blocked this deal between Tapestry and Capri. Capri is down 5.5%. That dominance in the handbag world is going to be a free-for-all, quite literally, in the handbag world. Get ready to grab your market share. But what happens next to Capri is the critical question. Tapestry is at the bottom of your screen. They're going to do a $2 billion buyback. They're trying to soften the blow. The big question in my mind, how long does Lena Khan last at the FTC in this next administration? And what kind of a bid would that give to the tech world? You can ask your next guest that.
Manus, our next guest is an oil guest, but maybe we'll ask Dan Ives a little bit later when we catch up with Dan. Are you dropping Aladdin lyrics into your market checks now?
Why not? It's a whole new world here.
Thank you, Manus.
Thank you.
If you don't know, Manus sings before the show begins every single morning.
Yeah,
Started in London, continues in New York.
Honestly, it's wonderful. Everyone should watch the 5 a.m. And the reason that I'm laughing at every start of the 5 a.m. is because Manus will have just sung to me.
Disney songs exclusively?
Yeah, mostly.
I'm not sure what that's about. Under surveillance this morning, U.S. officials accusing Chinese state-sponsored hackers of a, quote, broad and significant cyber espionage campaign. The hackers allegedly stealing customer call records from AT&T and Verizon. The New York Times reporting that Donald Trump and J.D. Vance, as well as Harris campaign staff members, were also targeted.
So I was reading through this release yesterday from the FBI, and they're talking about also private communications of a limited number of individuals who are primarily involved in government or political activity. So you can see there the two campaigns. What's interesting is Jake Sullivan over the weekend was asked about this on Face the Nation, and he said, of course, every single American official that sits down with their Chinese counterpart will bring this up because it is a significant attack. Well, guess who's sitting down with Xi Jinping on Saturday? President Joe Biden.
I have to say, rarely does a week go by and we don't get some sort of warning from some Western intelligence official that China is looking into something. I was looking at this journal piece and it really just underscored how unprepared we are. They cite that for every China-backed hacker, there is 50 of them to one FBI cyber personnel. We are so unequipped from the growing threat. And it's going to be a really tricky situation because most countries can't afford to throw out a Chinese diplomat or put on sanctions. Of course, we're going to get some sort of round of that with Trump. It'll be interesting to see what sort of balance he tries to strike.
This cabinet is going to be packed with China hawks. Hegseth, China hawk. Rubio, China hawk. The list goes on.
Also, his national security advisor, Representative Walt, China hawk, who is an individual who was for the TikTok ban and who said TikTok is Chinese espionage in an app for social media, something that Donald Trump has wavered on and doesn't want to actually block. He's worried about competition, but the individuals around him, the personnel around him, they are China hawks, and they are individuals who want to see something like a TikTok ban.
The to-do list is so long. Let's get you the latest on this next story. Nippon Steel's vice president is set to meet with Pittsburgh steel workers next week as the Japanese firm continues to make its case for a U.S. steel takeover. The visit coming as both companies await a decision about Nippon's pending transaction. President-elect Donald Trump saying on the campaign trail he will block the deal.
He said he will block the deal. Joe Biden says if it gets to his desk, he will block the deal. Right now, it's still living in the CFIUS purgatory, pretty much used, as you could speculate, that CFIUS was used to basically have a hiding place for this deal because they didn't want to disrupt the election and those crucial votes in Pennsylvania. But while it's still in CFIUS, or waiting for that to come out, you see Nippon Steel trying to get ahead of it. They're going to the union plants. They want to go to the factories, talk to these workers. Maybe there's a window where something can get done.
And just finally on Meta, Meta will face a scaled-back antitrust trial over its alleged social media dominance. A federal judge narrowing the FTC's claims, but rejecting Meta's main argument that its acquisitions of Instagram and WhatsApp were good for consumers and not an effort to monopolize the market. Manus mentioned what's going to happen with tech. It's a big focus for the likes of Meta.
And of course, who is going to be leading the FTC? Lena Khan, actually, her term is technically over. She just stays on until there's a new chair appointed. It is likely not going to be Lena Khan, even though J.D. Vance has said she's one of the few individuals in the Biden administration who's doing good work. But take this lawsuit, for example. It was actually filed under Trump 1.0. It was filed in 2020, one of two by the first administration to curtail the largest of the U.S. tech platforms.
You know, going all the way back to when those transactions were made, I think we've got to go all the way back to when those transactions were made. I remember that morning in London and going on European TV, and we had a whole host of guests who thought they were overpaying for the asset. That's how people thought about the transaction at the time. They thought they were overpaying for the asset, and here we are 10 years plus later, and we're sitting here saying, oh yeah, shouldn't have allowed that to go through.
Because they're pervasive now. WhatsApp at one point was young. Not a ton of people were using it, especially just in Europe. Now, actually, it's used more pervasively around the world, even in the United States.
Yeah, but, I mean, there's TikTok. This isn't a monopoly, right? Like, there is real competition. And President-elect Donald Trump has mentioned this as to why he wants to keep TikTok around. I think this speaks to what kind of environment are we going to have? Sure, these were filed under President Trump, but maybe it's just less energy is put towards these, that there are less appeals. More things are kind of allowed to fall by the wayside because, again, Trump, I think, doesn't see it as a monopoly because there is TikTok.
Dan Ives of Wedbush joining us shortly. Look out for that conversation. Here's the latest elsewhere in the commodity market. Brent crude at the moment, 72.64. WTI, 68.79. Eric Lee of Citi writing the following. A Trump presidency and red sweep is likely to be marginally net bearish for oil in the base case. And as oil's fundamental outlook was already bearish, we continue to see Brent oil prices averaging $60 per barrel during 2025. I'm pleased to say that Eric joins us now for more. Eric, good morning to you.
Morning.
Marginally net bearish. What is it about this presidency that is marginally net bearish?
I mean, there's three big things out of many things. One is trade tariffs. They're, generally speaking, negative for the economy, negative for oil demand. Second of all, a second Trump administration is looking at releasing the fetters of the U.S. oil and gas industry. There might be, on the margin, some more supply. That's net bearish for oil. And then thirdly, he claims a stronger relationship with OPEC Plus, maybe getting them to release more oil to the market as well, especially he's talked about halving energy costs. Now, the other side of the ledger is people's concerns over whether there will be harsher sanctions on Iran, and that would cut supply there. But it's looking like that might be less of a probability at this point in time.
Your second point, Donald Trump would call drill, baby, drill. What is the break even where Donald Trump thinks it's acceptable for consumers to have a low enough price but not bust the shale industry?
Well, I don't know that number in terms of what's in his head, but in terms of the U.S. shale industry, you could probably be at $50, $60 prices, and that would be the point where the U.S. oil production would probably flatten out and stay flat on a sustained basis.
What kind of production do you think OPEC is willing to add to the market? Because today we have IEA data that says the market faces a surplus of more than 1 million barrels a day next year.
Yeah, we've been calling for this kind of view really since earlier this year. That drives our $60 price view for next year. What is OPEC Plus willing to take? I mean, it's hard to say. Last year, the year before, Saudi Arabia and other producers were reacting at $90 oil, $80 oil as a kind of floor. We're now in the 70s. There are a couple of important producers in OPEC Plus that are probably itching to use their spare capacity. The UAE, maybe even Russia over time as it's developing its production capacity as well.
Well, we even just saw Kazakhstan recently overshot its oil output under OPEC Plus. It is a Saudi that's had a difficult time exerting that leadership. We saw in the first Trump administration, he was able to kind of come in with sharp elbows and get them to do some things that he wanted. Does he possess that ability with Saudi now when they're still struggling to contain the bloc?
Yeah, I mean, on the Saudi side, it seems like in a sense, part of the group's agreement to start unwinding cuts in January, which they might postpone, but the agreement to do that's probably in part hinging on the fact that these producers need to comply more, right? Iraq, Kazakhstan, Russia, and to some extent they have. Other than that, you know, these producers I think are itching to bring things back. And other than that, if prices keep moving lower, supply outside of non-OPEC Plus is growing fast, demand is weak, it may be tough for them to continue to hold prices higher.
So much of this also is going to be down to geopolitics. I know a lot has been gone back and forth, a lot of volatility as to whether we price that in or not. What sort of environment do you think we'll be dealing with the Middle East, with Trump coming into the White House?
There are concerns over Iran. May there be harsher sanctions in Iran? What would that mean for Iran's production and exports? Would that tighten the oil market? That might come at the same time as OPEC Plus releases oil to the market with encouragement from a Trump administration. So it could be offset. Similarly for Venezuela sanctions. And then on the other side, if there is a quicker resolution to the Russia-Ukraine crisis in some way, that could ease energy prices as well.
Eric, but what Iranian sanctions aren't ready on the books? The sanctions are there. Mm-hmm. Will this Trump 2.0 have the appetite to enforce them?
That's a great question. Right now, Iran is exporting somewhere around 1.5 million barrels a day. Sanctions have been on, as you say, for a long time. More sanctions were put on fairly recently by the Biden administration. It's gotten to a point where most of the buyers of oil are Chinese teapot refineries that are not particularly exposed to the US financial system. And that's the main source of leverage for these sanctions. So unless there's a different tool that might be wielded for this, it may be tricky to reduce Iran's oil exports that much further. Maybe somewhat, but not that much further.
Eric, a lot to think over. It's good to see you and catch up. Thank you, sir. Eric Lee there of Citi. Brent crude at the moment, 72.71. WTI, 68.84. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. LVMH reshuffling its divisional leadership. Bernard Arnault's son, Alexander, moved to the luxury giant's Paris headquarters and will become deputy chief of the wine and spirits division. He was previously at the New York-based jeweler Tiffany & Co. LVMH also names a new human resources head after the previous head left the company. This fueling more succession speculation as Bernard Arnault remains CEO, but his children all have key positions at the group. Klarna filed for an initial public offering in the U.S. The Swedish payments firm submitted a draft registration statement to the SEC. The number of shares and the price range have not been determined, but the implied valuation is about $14.6 billion. Sources tell Bloomberg the IPO is expected next year, and the company is working with Goldman Sachs, JP Morgan, and Morgan Stanley to arrange the offering. And New York renters no longer have to pay broker fees when signing a new apartment lease. In a new measure passed by the City Council on Wednesday, the Fairness in Apartment Rental Expenses, or FAIR Act, was approved. Landlords who hire real estate agents will have to pay the agent's fee themselves instead of passing them on to tenants. There is a 30-day window for the mayor to sign the act into law, and it will take effect 180 days after. That's your Bloomberg Brief. John?
Yahara, thank you. I'm not in a position to advocate for things, but good. Up next, supercharged by a Trump win.
America is going to reach heights that it has never seen before. The future is going to be amazing.
Come on up here, Elon. He created the first major American car company in generations. Come here. Take over, Elon. Just take over.
And that stock absolutely surged over the past week. That conversation up next.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Live from New York City, equity futures right now positive by 0.1% in the bond market going into PPI data and jobless claims later this morning. That data drops at 8:30 Eastern time. The 10-year at the moment down almost a basis point, 4.44. Under surveillance this morning, supercharged by a Trump win.
President Trump is the only one who can save democracy.
America's just not just going to be great. America is going to reach heights that it has never seen before. The future is going to be amazing.
Where is he? Come on up here, Elon. He created the first major American car company in generations, and his rocket company is the only reason we can now send American astronauts into space. Come here. Take over, Elon. Just take over.
So here's the latest. Tesla shares surging nearly 40% over the last week as President-elect Donald Trump awards his ally Elon Musk a role overseeing government efficiency. Dan Ives of Wedbush seeing upside ahead, writing Trump will fast-track the autonomous and AI initiatives. In our view, over the next 12 to 18 months, that will be a game-changer to the Tesla story. Dan Ives joins us now for more. Dan, good morning to you. Let's talk about these numbers. Up 36%. In 7 trading sessions, that's $280 billion of market cap. We're talking like 5x of Volkswagen. Doing that in a week. Why?
Get the popcorn out. I mean, I believe this is just the beginning.
That's an expensive movie.
I think it's just the beginning because of the autonomous and AI piece. And I ultimately believe now with Trump in the White House and Musk a very big seat at the table, this is the start of what I believe is autonomous is going to get fast-tracked over the next few years. And when I believe the AI autonomous piece alone is worth $1 trillion of valuation to the story.
Let me jump in. You say fast-tracked. What does that mean? Fast-tracked by who?
Well, if you look on the federal agency side, I mean, even there are some things in the state, that's really been the spider web that I believe has been holding the autonomous FSD and a key part of the valuation for Tesla, because my view is if you start to significantly increase FSD penetration and you look at Cybercab, where Street doesn't even think that's coming out till 2027, 2028, you fast track that 2 years, you look to ultimately see now the autonomous story really play out. I don't believe any autonomous valuation is factored into Tesla even today.
It's got to work, though, and they've already got a playground for it, California. Have they demonstrated it works? Are Waymo doing a better job?
Look, look, when you look at Waymo, ultimately the scalability for Tesla is what I believe is the key. And I think when you look at this latest FSD, when you look at the latest version, and you look at what I believe what we're going to see over the next 6, 12 months, I believe autonomous, when we talk about level 4 and true autonomous, we get to the end of next year. If regulatory spiderweb disappears, which I believe now it is, I think this dramatically changes the Tesla story. And I believe we're going to be sitting here talking about Tesla $2 trillion and so on as the AI and autonomous piece play out. Because I think for Musk, this is a bet for the ages on Trump. And ultimately now he essentially becomes not just a big seat at the table, but someone that's going to have a huge influence even when it comes to China tariffs and others.
But this Department of Government Efficiency has no authority. It has no money. They are just going to make recommendations. So are you really actually just betting on Elon Musk's proximity to power?
I mean, look, this is, I think, just the first start. Because I think he's going to be essentially AI ambassador. He's going to have a huge piece when it comes to China tariffs. And he is going to be essentially...
That's an important point. Why do you think he's going to be a huge piece when it comes to China tariffs? Ambassador Lighthizer on board, big China hawk. Senator Rubio's coming on board, big China hawk. You think someone outside the government, in Elon Musk, with a fake department, is going to have some influence on tariffs on China?
I think there's no doubt that he's going to have an impact on tariffs because everyone understands, even within the Trump transition team, and tariffs, the key is they could talk tough on everything else. But when it comes to chips, Tesla, Apple, that's the crux of the AI revolution, and it's the crux of big tech. And I think part of why you see big tech so resilient, besides, I think the consensus view that Khan's out, it's just a matter of when the press release hits, is that ultimately this now lays the groundwork for tough on tariffs, but I believe there will be carve-outs when it comes to Tesla, Apple, and others. And I think Musk, no one understands the jigsaw puzzle of China as well as Musk, and of course,
Dan, have you seen the reports that Elon Musk is wearing out his welcome around the Trump transition team?
I mean, look, as someone that, I feel like I have a pretty good pulse on the whole situation, I strongly disagree. I think this is actually an alliance in terms of Musk and Trump that gets stronger, not weaker. So our whole view is that I think we sit here a year or two from now and being like, why is Musk now involved in X, Y, and Z? Now, in terms of the balance and what that can mean, given Tesla, given SpaceX, Tesla investors, and it's part of, as Farrell talked about what the stock's done so far, I think it's justified because it's a new age, a golden era, not just for big tech with regulation gone, but I think for Musk and Tesla.
It goes beyond Tesla. I mean, Elon is sparred with a lot of government agencies when it comes to SpaceX. He's called on the FAA chief to resign. He's sued the National Labor Relations Board. He's accused the California Coastal Commission of targeting SpaceX. Are we going to see some real changes with that type of enforcement for SpaceX?
Think about it like Musk was a student and he's essentially in detention, the teacher of federal agencies. Now, all of a sudden, he becomes the principal, essentially. So this is going to shift things a lot in terms on the federal side. I think a lot of the federal spiderweb, I'm not saying there's still going to be issues there. A lot of that disappears under a Trump presidency. And I think Musk is going to have an outsized influence when it comes to a Trump presidency, which is key for Tesla, because ultimately when it comes to Tesla, this is going to be one where you could say, even when it goes to Twitter and X, you talk about 30 billion that maybe he lost on that, but he gained what I view is probably $1 trillion or $1.5 trillion of value when it comes to, in terms of this Twilight Zone jigsaw.
So you say
puzzle.
he's going to move to this principal role, and he's going to have this proximity to the president-elect. We already see that proximity. Is it appropriate then that he does not divest his personal financial holdings, even though it's going to have such an influence, you say, on American policy?
Look, and ultimately, until it's not an official cabinet position, so there's no change that needs to be in terms of CEO, in terms of his stock ownership and everything else. Will there be noise? Will there be, will there also be criticism? Yeah. But I believe this is something where the benefits far outweigh the negatives. And that's why it's like, look, right now, a lot of the bears for Tesla sitting in their hibernation. No,
are there any bears left after the move of the last week?
What I'm saying is the bears sitting in their hibernation, in their caves, they can't find AI in the spreadsheet.
Wearing black.
Wearing black. They can't find AI in the spreadsheets. It's an auto company. In my opinion, it is the most undervalued AI play in the market.
One final question, because we've stress tested your position on Tesla enough. The stock has been flying. It's hard to disagree with the price action of the last week. Can you give us another pick? What do you like right now that's sort of under the radar, that's not shining brightly, that you think will?
Well, I mean, it's still massive AI Palantir. That continues to be what I view from when it comes to AI, where everything's going. I think another name to me that sticks out, even like further going, like that I'm not getting credit, is Salesforce.com. I think Salesforce.com, when it comes to the AI story, what Benioff's going to do, not even touching the base in terms of what I think this could.
We've got a minute. What is Benioff doing right now that you think's underappreciated?
I think it's the install base, and it's everything that we're seeing with our checks is that at first it was actually disrupting sales cycles. Now, I believe this is something from a monetization perspective. This could be an incremental 10, 15, 20% of revenue over the coming years, but also betting against Benioff, it's like betting against Godfather of AI Jensen, betting against Nadella and Cook. It's in that same, crowd. And look, and I think next Wednesday when the watch parties start and we have NVIDIA earnings, it just shows we are still at 10 p.m. in the AI party that goes to 4 a.m.
I'm looking forward to covering that story with you. You're going to catch up with us next week.
Great.
We're covering video. Looking forward to it, Dan. And looking forward to the F1 as well.
Next Friday, I'll be fully geared out. Ferrari. I'll be all wearing all my Ferrari gear in Vegas.
So bright red.
Bright red.
Nice. They do it yellow as well.
And I'll do some yellow there too.
Just a sprinkle of yellow.
Look, it's all in
classic Ferrari colours.
Classic Ferrari.
Nice. Appreciate that. Dan, thank you. Dan after Wedbush, very bullish on Tesla, and that stock has been flying over the last week. Coming up in the next hour, we'll catch up with Liz Young-Thomas of SoFi, Geeta Raghunathan of Bloomberg Intelligence with Disney up in the pre-market. We'll catch up with Greg Dacko of EY and Brian Weinstein of Morgan Stanley. Brian Weinstein of Morgan Stanley thinks that credit yields in America, investment grade, can trade through treasuries. Just think about that. We'll catch up with Brian in about 30 minutes' time. From New York, this is Bloomberg.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And, in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. In the meantime, some people who care about this issue are really out, trying to think, do we need permitting reform? Do we find, what new ideas haven't we found yet? How do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Our principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon and Sudan and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the party. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Momentum is a powerful thing. It's hard to fight against that trend.
The way that both the stock market and the bond market have acted is logical.
One thing that we can say is that the election result and what's coming out from there is just simply reinforcing a narrative that was already in play.
If you do actually get a shift back to rate hikes, it could really go against that bullish sentiment right now.
Sentiment, the news flow, it was already very, very strong. At some point, you think there's got to be a breather.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Horder.
The third hour of Bloomberg Surveillance starts right now, and in 30 minutes' time, you'll get some economic data. Jobless claims in America still exceptionally low, speaking to a labour market that's still okay on a headline basis. Then we get some PPI data at the same time. Then this afternoon, at 3 p.m. Eastern Time, you'll hear from the Federal Reserve Chairman, Jay Powell, on his economic outlook, except his economic outlook is very different to your economic outlook, because his economic outlook does not include anything on what's about to happen in this White House, helmed by Donald Trump.
It doesn't include it at all, neither will the summary of economic projections in their next meeting in December. It's a completely different world that they are living in. And I should say, not just from the conversation, but from what the market is doing. Longer-term yields keep pushing higher, and Powell, for the most part, has been writing it off, saying it's not an issue. But this market is pricing in inflation, it's pricing in tariffs, and Powell's not thinking about it.
The market is pricing in the political economy. The Fed has yet to price in the political economy. And they're in for potentially a rude awakening when it comes to January. And the first order of business could be the tariffs, which may be inflationary according to most economists you see. Now, when tariffs were part of the agenda in the first iteration of Trump, the FOMC said this is a one-shot hit. You can look through the rest. There's not going to be this vicious cycle. If they're so high, these walls, will that remain the same?
The former Vice Chair of the Federal Reserve, Richard Clarida, was on the program with us last week, going into the Fed decision and the news conference with Chairman Powell. And ahead of that news conference with Chairman Powell, the point that Rich made is that this Fed's probably going to start to look for some optionality, at least look to find some, to give them the choice to take a pause if they need to, going from December and beyond. And you get a real sense that that started in baby steps in the news conference, and I think you've heard a little bit more of that from Fed speakers in the past few days.
I do think we have. Lori Logan talking about higher yields might be an issue for them. Neil Kashkari saying that inflation, they need to be sure it's vanquished. But it's really clear that they're not talking about it necessarily in the politics yet. They're talking about it in the abstract, that we still care about inflation. We care about this market. I want to know when they're going to more directly be saying, we're watching what tariffs are doing, and we're going to react to that, and we're going to need to react to that. Kashkari did that slightly, but we haven't had really, I think, an honest conversation about it yet.
Really small steps to getting to that destination. Here's a snapshot of the price action. Equity futures on the S&P 500 firmer by just 0.1%. In the bond market, yields just a little bit lower, down by almost a basis point, though still near 445 at 444.52. And in foreign exchange, if you missed this, if you're just waking up and tuning in, maybe you're on the West Coast, on the euro dollar 104 handle. A little bit earlier this morning, we're back to 105.33. It's another day of euro weakness. Coming up this hour, we'll catch up with Liz Young-Thomas of SoFi on whether the post-election rally still has room to run. We'll speak to Greg Deco of EY on why a December rate cut is still very much on the table. And Brian Weinstein of Morgan Stanley looking ahead to comments from Chairman Powell later on this afternoon. We begin this hour with the equity rally losing just a little bit of steam as investors look ahead to the latest economic data at 8:30 Eastern Time. Joining us now is Liz Young-Thomas of SoFi. Liz, welcome to the program. I was mentioning at the start of the hour just then that the outlook for Chairman Powell is very different to the outlook of many people that come on this program, precisely because he will not speculate on the future of policy changes. How much has your outlook changed since we last spoke?
Well, I would say the thing that you have to respect in the market right now is the momentum and just the optimism surrounding growth for 2025 or starting in 2025. And the idea that even though I think people recognize there are still question marks or headwinds that are possible in inflation, in the form of tariffs coming through, in the form of just a slowing economy that was happening before the election and could maybe rear its ugly head again at some point in 2025, I think the general consensus right now is that any growth uptick that we might see next year will circumvent any of those headwinds. So that's the way that the market has been behaving. And what we saw right after the election, obviously a very, very strong relief rally and a cyclical rotation because of that excitement. So now we've taken a little bit of a pause, which I think is natural. Maybe we give some of it back. I mean, if you look at the charts of a lot of these asset classes that have done well since the election, the lines are just straight up to the upper right corner. So you have to, usually when you see something like that, you have to let rationality come back in for a little while before we can resume another uptrend.
Liz, we've seen a similar move in the bond market as well. I remember a note you wrote in the last few weeks, actor in a leading role, bond yields. Bond yields are still that leading role for many people at the moment. Yields were creeping higher at the long end in yesterday's session. We've had this conversation before. I just wonder how your thinking is evolving on the subject when that starts to become a constraint around equities.
Well, I think it's starting to become a constraint now because we're knocking on, or at least we're on the doorstep of the next mental threshold, which is 4.5% on the 10-year. So the first one was about 425, 430, and equities were questioning it, but didn't really have much of an issue, and stocks continued to rise through that point. Then we get to 4.5, and people start to get a little bit more trepidatious about where we're headed. I think the big question, though, that investors are trying to answer is why is the 10-year rising? If it's rising because the economy is strong and because we have an improved outlook on the economy for the following 12 months, then that's less of a concern. And the prevailing wisdom would be that equities can withstand a tick up in the 10-year yield if it's for good reason. But there continues to be this narrative about the deficit increasing. Is it because of debt? Is it because of inflation fears? Is it because of other central banks taking action and perhaps not buying as many treasuries, buying things like gold instead? So we don't have the answer to that question yet. I think it's a good one for investors to be asking. If we get even close to 5% in the 10-year, I would expect equities to struggle between now and then for sure.
Liz, you could make a really easy argument, not saying it's right necessarily, but an easy argument that it is about growth. Cyclical stocks have been the ones that have outperformed. The rise in yields has been tracking pretty steadily the Citi Economic Surprise Index. Are we maybe overstating a bit just how much of this is about pricing in President Trump?
Well, so that's the thing that you want to pay attention to. You need the market, the equity market, to confirm basically your thesis on the yield. So if the 10-year yield is rising because of growth, as you suggest, then you would see what we have seen since the election, where cyclical sectors have led. The thing I would caution people on is that if we're trying to mess with the trade balance at all in 2025, we're in an environment right now where the dollar has been strengthening and continues to do so. If we hit an environment where the dollar is strong, we would consider that about one standard deviation away from a long-term average dollar strength level. So if we're in an environment where the dollar is really strong, you actually tend to see defensive sectors start to take over. And we're right at the precipice of that, meaning we're right at the precipice precipice of that strong dollar environment. If we start to see a rotation into defensive sectors, that's when I think you have to sit back and question whether or not this yield move is going to start to change the way that investors have appetite for risk in the equity market.
If that happens, Liz, what becomes the haven? Because it's usually bonds. It's usually the state asset class that you can rely on. But we're starting to find some sort of floor under these yields with those fears of expanding fiscal deficits, of inflation. What do you turn to then?
Well, I think initially investors still want equities. There has not been this big rotation out of the equity market. Even in times of stress throughout this cycle, you still see investors trying to rotate within equities rather than wholesale coming out of equities. So start to look for those defensives to come back first, things like utilities. That was the usual suspect in 2024. Staples, although seemingly expensive right now, but paying a good dividend and in that defensive category. Healthcare and health insurance, I think, could see a nice bid. And then if we continue to get a lot more fear in the market, or if there's concern over yields going even further, then I think you start to see a rotation into other safe haven assets. But I think the first way would be gold. You've got a lot of appetite for gold from institutions and from central banks, but there has not been a lot of appetite for gold from the retail investor yet. So I think we could see that pick up as well.
Liz, I want to talk international and finish there with you. It was only a month or so ago, we had people coming on the program talking about dollar weakness, dollar bears, and international performing. China, let's get long China. The Hang Seng, the CSI 300, both down in today's session. They've struggled more recently. Liz, I can't find a single person right now, stateside at least, that wants to even talk about getting long Europe. How are you thinking about the international story versus the US?
Well, you know, it's interesting. I'm not going to sit here and say that I'll be the only one to do it, but you always have to question when there's nobody saying it, is that a good contrarian indicator? So what's happening right now, I think, has a lot to do with the currency market. And when we're looking at Asian currencies in particular, if you look at Japan, if you look at China, do not underestimate both of those nations' ability and willingness to support their own currency. So I don't think that there's a lot more pain that they're going to take before they start to take measures to support their own currency. So I would expect currency volatility around the globe to actually pick up over the next few months because of this dollar strength. And obviously we're seeing a lot of weakness in the euro as a result too. There are other issues that are going on in Europe, but I think there are some measures being taken in order to stimulate as well. But we do need that European consumer to come back. We need European luxury to come back. And some of this dollar strength is just confusing the issue for now.
Need some big changes in Europe, that's for sure. Liz, appreciate your time as always. Liz Young-Thomas there of SoFi, just finishing on the FX market. Dollar strength once again against the euro, a fifth consecutive session of euro weakness. With an update on stories elsewhere this morning, let's cross over for your Bloomberg brief to Yahara Hackers. Hey, Yahara.
Hi, John. We start with the latest on President-elect Donald Trump's cabinet. Former Congressman Matt Gaetz has been tapped as Attorney General designate, while former Congresswoman and former Democrat Tulsi Gabbard is the pick for Director of National Intelligence. And Trump confirmed that Senator Marco Rubio is his pick for Secretary of State. But yet to be announced is who he wants to run the Treasury Department. The Wall Street Journal reporting Cantor Fitzgerald CEO and transition co-chair Howard Lutnick is making a late play for the role. Meanwhile, the vice president of Nippon Steel is heading to Pittsburgh next week to meet with U.S. steel union workers. The move signals that the Japanese company is making a push to persuade rank-and-file employees its $14 billion takeover bid will be good for their long-term prospects. The news comes as both companies await a decision about the pending deal from the U.S. Committee on Foreign Investment. During his campaign, President-elect Donald Trump did say he would block the deal. And U.S. officials say Chinese hackers breached multiple telecommunications companies in a broad espionage campaign. They reportedly targeted the phones of President-elect Donald Trump and J.D. Vance, among others in politics. China's foreign ministry spokesperson said the nation opposes disinformation due to political agendas. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, The Morning Calls Plus, we'll speak to Geetha Raghunathan of Bloomberg Intelligence as Disney gets a box office boost. That stock is up in the pre-market by more than 8%.
politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power live around the world every weekday, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
In about 15 minutes' time, some economic data, PPI and jobless claims. Look out for that. Going into it, equity futures positive by 0.1% on the S&P. The bond market, some stability for you, just short of 445. Yields at 444.72 on a US 10-year. Let's get you some morning calls. First up, HSBC hiking NVIDIA's price target to 200, seeing more upside in data center momentum. That stock is up by another 1% in the pre-market. Next up, Barclays upgrading American Airlines to equal weight, saying the carrier will regain market share in corporate travel next year. That stock is up by 1.6%. Execution this year has been a real problem over there. And finally, Evercore adding Target to a tactical underperform list, expecting further sales trend deceleration. That stock just a little bit softer. We're negative by 0.4%. Let's turn to Disney, the company beating expectations thanks to a streaming boost and this year's box office performance, underscoring the turnaround set in motion by the CEO, Bob Iger. Joining us now is Geetha Raghunathan of Bloomberg Intelligence. Geetha, that stock is up nicely in early trading. It's rare to provide not just a one-year outlook, but a 2- and a 3-year outlook as well for profits. Where's that clarity on the future coming from?
Oh, investors are loving it, John. I mean, this was the biggest thing that, this is exactly what the doctor ordered, right? The biggest problem with Disney was the lack of clarity on how things were going to pan out, in fiscal 2025 and obviously in the future. And with them kind of giving us that detailed line by line item kind of guidance, they've really set the tone and, giving us a lot of visibility into high single digit earnings growth. So good momentum sustaining into fiscal 2025, and then as you get into fiscal 2026 and 2027, they're projecting double-digit EPS growth. So really a lot to look forward to for Disney investors.
A lot of the success of this quarter, Geetha, came from their box office, from Inside Out 2, from Deadpool and Wolverine. It wasn't that long ago that Disney was rethinking the spend that it would be doing on content. Given that it was movies, something that during the COVID era really lagged behind and was impossible to go to, was kind of the stick, the thorn in the side of Disney. What does it mean about how willing they're going to be able to spend on content going forward?
Yeah, you're absolutely right, Danny. I mean, they had huge problems, of course, with COVID, with the pandemic kind of shutting down theaters completely, and them kind of really almost over-investing a little bit in their streaming business. So, in fact, when Bob Iger came back, he said the problem was not just content and a little bit of subpar content. It was just that there was too much of content, and it was almost kind of oversaturating and leading to this franchise fatigue or exhaustion amongst investors. And so that's something that, there's been obviously a course correction on that front. They're really now focusing on paring back on content, on taking the focus back to quality rather than quantity. And you see that in their multi-year kind of strategy that they've laid out for all their biggest franchises, whether it's Marvel or Star Wars or Avatar. They have really a very good strategic plan in place. And we're going to see that kind of, it's not just Inside Out and Deadpool, just in the next month or so, you have really two very, very highly anticipated movies kind of setting the tone for fiscal 2025. With Moana 2 and, Mufasa, which is the big Lion King live action movie.
Well, and John started with this. I mean, they have a clear plan and a clear outlook and a clear guidance up through 2027, which, by the way, Geetha, at that point, we should have a new CEO or at least a new one announced by Iger. Just given that strength that they're coming from and the plan that they've laid out, does that change the type of person we might see?
So that's a great point that you bring up. So Disney has always historically kind of looked inwards. They've always had this deep bench bench, this pool of candidates that they've drawn from. But just a few days ago, we actually got some news suggesting that they've actually started looking outwards. In fact, Andrew Wilson, who is the CEO of Electronic Arts, a big gaming company, has also kind of been thrown into the mix. So it's going to be interesting to see, who exactly. Obviously, they do have all of their, division heads who are also in the running. The ESPN head, the Parks head with Josh D'Amaro, Dana Walden. So it's going to be interesting. But you're absolutely right that their choosing of the new successor will definitely kind of tell us which path this company is going to go forward on. Is it going to be more operations and a Parks-driven focus, or is it really going to be content, which is really an IP, which is kind of really the driving force and the engine for all of these companies' different segments?
Geetha, do you have a timeline for how long this is going to take?
So the successor, they had initially said, Anne-Marie, that it would be in 2025, but they've actually pushed that out. You have James Gorman, who's now leading the process. They've pushed it out to 2026. So by 2026, we should have, the name of the new CEO. And by the end of 2026, Bob Iger is set to finally kind of lead the company.
Well, we've been there before. We've seen that story before. What have they learned from that episode?
Oh, too many things, right? This has been the biggest misstep for Disney. And so obviously they want to get it right, which is why they kind of have James Gorman leading this process, which is why they've kind of expanded the search now to include really everybody. And just having kind of Gorman there, I think, inspires a lot of confidence. He has orchestrated a fantastic succession at Morgan Stanley. He is set to be the right person for the job. And, he's also the chairman of the board. So I think there's a lot of confidence that they will get it right finally.
Hang on, Geetha. Why isn't the lesson that they learned that they should just be looking internally? Isn't that the lesson of Iger coming back, that maybe widening the tent to external people doesn't make sense and maybe misses the culture and the direction of Disney?
Yeah, it's really hard, Danny. I mean, Disney is such a diverse company, and they've tried internal candidates. So Bob Chapek was an internal guy who was running parks, an absolute veteran who couldn't really manage all of the pulls and pushes at the content division. Right? He didn't know a lot of how to handle things with the creatives, with all of, how to hobnob with all of the Hollywood talent. And that's kind of what got Disney into a little bit of a mess. I mean, before that, of course, we had the whole Tom Staggs and the Jay Rizzullo situation. Again, two very successfully groomed internal candidates. They went through the whole process, but again, suddenly at the last minute, it didn't kind of pan out. So it's going to be interesting. Of course, the internal candidates have a lot of experience, but again, just with the divisions, right? You have parks on the one end, and then you have a completely different animal when it comes to content and the studios and the ESPN business. So they are obviously very big shoes to fill. So again, it's going to be a little bit of a wait and watch.
Let's talk about the parks, Geetha, because in the quarter that they reported, there was some weakness, but they're projecting 6 to 8% operating income growth in the quarters to come, in the year to come, rather. What's going to be driving that? What sort of environment with consumers and willingness to go out to parks, to go on their cruise ships, are we going to be seeing?
Yeah, so 2025, fiscal 2025, Danny, is a really interesting year for Disney because you have a big competitor kind of coming out with Epic Universe, which is the new Universal Park that's coming out in Orlando. But for Disney itself, yes, they have seen a moderation in demand across their parks, but at the same time, they are launching cruise ships. So what is really driving that big, high single-digit increase in profits in fiscal 2025 is going to be the launch of these 3 new cruise ships, which, of course, in the beginning of the year is going to kind of weigh on profits because of launch costs. But once they get up and running, those are going to be the big profit drivers.
When it comes to the profit driving on the content side, we're seeing this growth in streaming, and that's offsetting the decline in these cord cutters. Last month, Comcast was talking about spinning off its cable networks. Any change in portfolio you see going forward for Disney?
I think they were asked this question just a few minutes ago, the CFO, and he said he likes his linear TV portfolio as is. That said, Anne-Marie, they do have a very big event coming up in fiscal 2025 with the launch of a streaming standalone ESPN product. Now, this kind of really puts everything in play, right? It puts their TV networks in play. One of the reasons that they might have been reluctant to kind of offload the TV networks was because, of this ESPN. ESPN is kind of the glue that holds the whole TV bundle together. But once that goes over the top, I think it's a fair question. I mean, why not, spin off their TV networks? They really have nothing really holding them back, in my view. But so far, they seem to want to hold on to it, I think, at least until the ESPN launch goes off successfully.
Geetha, how much more money do they think they can charge us for Hulu? It's driving me nuts. Every few months I get the email.
Lots more. So, I'm saying that because you just look at their profit projections, John, in the streaming division. I mean, not only have they turned around, that division after 4 billion losses 2 years ago, 2.5 billion 1 year ago. This year, of course, you have a modest amount of profit. Next year, they're projecting 1 billion. And then what's really interesting for fiscal 2026, John, is they're projecting almost, I would say, almost a tripling of that profit from 1 billion to 3 billion. So all of that is going to be driven, at least in my view, by pretty big price increases.
I'll pay up if they release a new season of Shogun in the next 6 months. All right, Geetha, appreciate it. Geetha Raghunathan there of Bloomberg Intelligence. I forget what I'm paying now, but it's ridiculous. You throw in the cost of broadband, and basically we're back to the bundle plus $50.
I want to know if that sports venture is going to come out. Remember that thing that a judge blocked with ESPN and Fox? I wonder if this is going to be a better environment for them. I think people would be willing to pay up for that because there's just so many different things you need to buy.
I have the solution for Jonathan. Go back to school. $1.99 a month, if eligible, if you're a student.
Is that what they do? So I should sign up for a course?
Yeah, sign up for a
free
course
course.
with ads. It's $1.99 a month. You can't beat that.
What should I study? That's the question.
It's up to you.
We'll figure this out. We'll
Commercial
work this
break.
out, yeah? Disney, up by about 9% in the pre-market. Up next on the programme, we'll turn to the economic data. PPI just around the corner, together with jobless claims. We'll get the view of Great Echo of EY, and then we'll get the market response, the market reaction. We'll catch up with Brian Weinstein of Morgan Stanley. From New York City, just a brief check of the markets for you. Equity futures on the S&P 500, up by around about 0.1%. No drama there. In the bond market, we're down a single basis point or two, 443.54. And in the FX market, more euro weakness. New lows for the year on euro dollar earlier on in the session, a 104 handle. At the moment, 105.38. This is a fifth consecutive day of euro weakness, and we're still trying to find a euro bull. If you're out there, reach out, write it on a postcard. We'll do an interview, a long conversation about why you like Europe right now. From New York City, this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Anne-Marie wants me to study the Beyonce course at Yale University for 60-something thousand a year. 60-something thousand a year, and your kid goes to study Beyonce at Yale University?
It's apparently going to be a single credit course, which then means you'll probably get the student discount on Hulu.
That's absolutely ridiculous. I'd rather just pay up for Hulu. Make more sense. Some economic data just seconds away. PPI and jobless claims in just a moment. With that economic data, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. Well, we've got a little bit of a surprise in PPI core, up 0.3, a little stronger than anticipated. The headline is up 0.2 on a year-over-year basis. Headline 2.4%, 3.1% for the core. That is higher than anticipated. John's favorite number in the whole world, initial jobless claims, 217,000. That is down from the prior month, and it looks like we are still in the throes of a strong labor market, which sets us up for an interesting retail sales report tomorrow because people still have money. According to the latest revisions, we still have more money than we thought we had. So overall, you still have the question about what does the Fed do in December?
I like the number, Mike, because it just is what it is, and it's just really low at 217. And for the Federal Reserve, who are worried about the labor market break-in, we had that gap out in jobless claims. I remember last summer, freak out, came back in. Gapped out more recently, freak out, comes back in. This is setting up potentially for a pause, maybe not in December, but perhaps going into 25. Is that how you see things?
It could be, because December, obviously we are adding a lot of part-time workers at the retailers and things like that, so you'll have fewer claims. But what it does show is that the hurricanes have washed out of the data, so the November numbers should be relatively strong if we get a rebound from what we saw in December. And that'll also raise questions about what the Fed does. And so at this point, it looks like the labor market hasn't moved at all. It stays about where Jay Powell and the Fed thought it was. It's the inflation numbers that we're watching now. And basically what we see here is sort of a confirmation of CPI, that we have stalled out at a certain level. Do we continue to stall out? How much of it is seasonal? Final demand goods were only up 0.1%. That's down from last month. Services up 0.3% in the PPI. So at this point, where do we go from here? That's the Fed's dilemma. And then you throw on top of that the policy questions.
I know you need to look through some more of the details of PPI, Mike, but when I look at PPI, and I know we care in so much that it feeds into PCE, which is, of course, the Fed's favorite measure, I look at a number like 2.4% year over year. Could I not just say, that's all asset managers? Stocks have gone up. They've been pumping out money. They've been pumping out and adding to that, and that's behind it.
We do want to look that up. And the thing about PPI, and the day that PPI comes out, the economists around the country who are extreme nerds get out their Excel spreadsheets, plug in the data like that number into their PCE forecasts. And I was reading this morning a PCE forecast that said it's going to be stronger than people expected because of asset management. There's been so much trading that it just pushes up the cost, and that is going to be something, that's the old pogo trade. We have met the enemy and he is us.
Off the back of this in the bond market, yields inflecting just a little bit higher, up a single basis point. PPI just a bit hotter than expected. Jobless claims a bit lower than expected. To weigh in on all of this, I'm pleased to say that joining us now is Greg Dacko of EY. Greg, welcome to the program. This is what I heard from Ian Lingen of BMO before these numbers dropped. He said Santa Claus has left the building. They're going to cut interest rates in December. Do you think that pause has left the building, Greg? And is there enough here and in the next 4 weeks or so to disrupt this easing bias at the Federal Reserve?
I think generally speaking, the Fed is still on board with this gradual easing cycle. You still have, if you look underneath the surface, fundamentals that are pointing towards disinflationary pressures into early 2025. You heard me say this in the past, where I look at consumer prudence in terms of facing these higher prices, reduced markups and reduced pricing power, easing wage growth, strong productivity. Those are all fundamentally disinflationary and will continue to push inflation underneath the surface towards 2%. Whether there is bumpiness in the near term, that's going to be a guaranteed element of the outlook. But I think the Fed really wants to recalibrate a little bit closer to neutral. And as to your question to Mike earlier about does it start to ease more slowly in 2025? I think yes. The upside risk to inflation in 2025 and 2026, and the fact that they're going to be looking for that neutral rate will likely make them go a little bit more slowly in 2025 in terms of easing.
Greg, do you think that neutral rate is closer to 4 than it is to 3?
Well, I think we don't really know, and the Fed doesn't really know, and Powell has expressed that. He will only know that once we're there. But I think with regards to traveling towards that destination, if you assume that by the end of the year we have a Fed funds rate around 4.4%, that tells you that they're going to be more cautious to navigate these easing cycle with a little bit more prudence, not necessarily going 25 basis points at every meeting, but perhaps skipping one meeting, pausing, waiting for the data to confirm the direction of travel, and also waiting to see any potential policy developments. Because we know some of the policies that have been pushed by the incoming administration risk being inflationary, whether it's immigration restrictions, deregulation that could favor a bit of stronger growth, or even later on, tax cuts and tariffs could all be inflationary over the course of the next couple of years.
And the market, the bond market, Greg, has started to price both that and just the good data we've seen. Is it not a problem for the Fed? As you say, they want to start normalizing. Inflation's coming in, but as they're attempting to normalize, that financial conditions are getting tighter.
That's right. That's one thing that they have to pay close attention to. And Powell didn't want to wade too much into that, into whether this was driven by the term premium, the rise in yields was driven by the term premium, by expectations of stronger growth, expectations of higher inflation, expectation of larger deficits. There are a number of factors that could play a role here. But the short end is really that if there is persistence in this tightening of financial conditions, all else equal, that would favor the Fed easing a little bit more because it does not necessarily want to have a more restrictive set of financial conditions. And that is really the way they're going to approach this. If there is persistence in this tightening of financial conditions, then they might lead towards more easing in terms of monetary policy. We're not there yet. I think we have to see how things evolve over the next couple of months with more clarity on the upcoming set of policies that will be developed in 2025 and 2026.
Greg, do you think it's right what we've heard from the Fed and what we're likely to get in the summary of economic projections, that they just don't include any assumptions whatsoever? In the words of Powell, I don't assume. Is that the right kind of language you want to see coming from the FOMC?
Well, that's absolutely right in the context of the uncertainty with regards to policies. But I would have liked, and we've talked about this in the past, I would have liked to see more of a forward-looking perspective in terms of economic dynamics. Just like I was talking about fundamentals being disinflationary, I'd very much like to hear the Fed and Fed policymakers talk about how they're looking at inflation dynamics rather than just comment on every single report that we get and comment on past data. I would have liked to see much more of that forward-looking perspective because that's important when you're guiding monetary policy. What are your perceptions around the future of inflation dynamics? Where do you see neutral? You don't have to be pinpoint estimating where it is exactly, but where do you think it might be, and how are you going to get there? That forward-looking perspective has really been lacking in this data-dependent world.
Hopefully we get some of that from Chairman Powell a little bit later on this afternoon. Greg, it's great to get your thoughts, as always. Greg Dacko there of EY. If you are just joining us, welcome to the program. Some economic data moments ago, PPI coming in hotter than expected. Looking at initial jobless claims coming in lower than expected. 217 against an estimate of 220. That's the right kind of downside surprise. Off the back of this, in the bond market, you'll see yields just starting to creep higher at the front end of the curve. On a 2-year now, up by 2 basis points, and at the long end, getting closer and closer to 450, a level that we have rejected a few times over the past week. 447.88, yields up on a session by 2 basis points. Mike, you had another look at the data. What jumps out?
Well, we're going to do a surveillance apology to all the traders out there, because the question Danny asked me, a securities brokerage dealing and investment advice down 2.3% for the second month in a row, a significant drop. So it is not not Wall Street's fault. But we do see health insurance up 0.2, property and casualty insurance up 0.8, and then airfares, airline passenger services, 3.2%. So those will go into PCE, and things won't look all that great. And the one other thing I got to point out to you guys, because you were just talking about cable TV services when I walked in here, cable TV services and bundled services up 6.5%. That's one of the biggest increases in the entire PPI. So yes, you can
Not a
complain.
shocker. A real world experience. Mike McKee, thank you. Brian Weinstein and Morgan Stanley with us around a table. Brian, welcome to the program. If we get a cut in December, is that the last one?
It's the last one for a while. It could be the last one. I think they take the first quarter off, at least the first two meetings. There's a lot of things that they have to sort through. I think this 100 we had got here was automatic, right? We can all talk about the data and every data point reacting to it, but we didn't. We didn't react to it. The data was stronger, and we used 100 basis points, right? The reaction was 550 was probably too high. 450 sounds more normal. Is it? We'll find out. So I think that's where we are, but I think it's time to watch and let the policy take effect and see what happens.
What concerns you? Is it the current level of things? Are you looking less of the trend and more about the levels and getting concerned that maybe we get stuck around these kind of levels?
I think we get stuck for a little bit. I mean, listen, our investors, speaking with their wallets, are buying fixed income, right? We see it everywhere. The money's coming in. You're getting a decent coupon. It should be a hedge for equities. It hasn't been a great, although now at the back of the highs in yield, the correlation's breaking down a bit, right? Equities are doing okay. So my instinct tells me the trade for next year is that we're going to seek out the higher end of this range. So, call it, 4% to 5.5% maybe for next year. I don't think we get there quickly. If we do, it's a problem. It'll hurt risk. But if we get there, kind of hang out at 4.5%, start to move higher, I think the market will be okay as long as it's a growth story. You have all the debt stories, you have inflation, but I think at the end of the day, the growth story is actually the important one.
And in the meantime, Brian, can you touch duration at all? There are just so many unknowns for 2025, and it's playing out on the long end of the curve.
Yeah, listen, when I look at the yield curve, I say, like, history is a great guide, right? 2s, 10s in a normal cycle should get to 150, 200 basis points. 10s bonds, let's forget the deficit for a second, just normal times, should get 80 to 100 basis points. I look at the yield curve and go, wow, if 2s are going to be stuck at 4.5, and you make a gulp, big gulp, right? If you had 200, you get some big numbers there, right? If that's where we're going. So yeah, I think duration has a place in a portfolio. It always does. And I could be wrong. Yields could fall 100 basis points. So I don't hate it as yields go up. But again, I don't see a reason to rush into it if you believe we're going to go back to normal looking yield curves and you don't think Fed funds is going to go back to 3, right? So there's a lot of variables around it. That's how I look at it.
But that's still not kind of the most comforting for, as you say, something that's usually the haven, usually something that's uncorrelated with equity. So what becomes that in the portfolio?
Well, listen, I think on the front end of the yield curve, you still get you can get good income without the duration. We've seen big flows into floating rate loans, short duration municipals, income funds in fixed income that have less duration and more coupon. So I think you can get coupon without taking max duration risk, is how I would look at it. And again, that's what investors have been buying.
I was saying you were coming on the program about an hour ago, and I teed up the credit conversation, so let's do it. The spread right now for investment grade credit is like this big, 76 basis points. It's as tight as it ever has been for the whole of this century. I want to understand from you why you think it can get a whole lot tighter from here.
I think it gets tighter from here. I think there are two major reasons. One is the buying dynamic, right? So listen, if I'm right and yields drift higher, there's a lot of government debt. We've covered that. There's less corporate debt relative. So people will continue to buy corporate debt. If the growth story is good, equities do fine. And so credit gets tighter. The second piece I think people don't truly focus on, which is the market structure has changed in the 100 years. How hard was it to trade corporate bonds when I started in this business in the early 2000s? Now you have ETFs, right? You have baskets of bonds trading. Credit is much, much more liquid. So if there's less default risk currently, too much government debt, and it's easy to buy, I would say, again, I would think there's a mathematical limit somewhere around 50 basis points, a little bit less, maybe. That's a pretty aggressive call. So I don't think we have to get there, but I do think in an orderly sell-off, credit will continue to frustrate people and continue to tighten.
Yeah, but your call is so much more aggressive than that, and you're burying the lead. There's the spread. You think this can happen? That Treasury yields could go above what we could see in corporate America, maybe not across the whole index, but perhaps possibly on a few credits.
Well, there's so few high-rated credits, right? The other century change is that the BBB part of the index is so much larger. So I don't think you have BBBs trading through government bonds. But for those few companies that can trade with an A, I do think there'll be a select few, some of them are really close right now, to go through government bonds. Do I think it's logical? No, the government can print currency, right? It's a better credit. But I think it's a supply-demand dynamic. And listen, you can make an argument argument that if you have fiscal irresponsibility, that maybe I'm wrong. Maybe they should trade through. So I think they will in certain credits, and I do think credit tights are not. We have not seen them yet.
Well, corporate credit is one of those markets that people look to get a signal for overall health. That okay, if spreads start to blow out, then I need to get worried. You mentioned the ETFs, but I also just wonder how much of this is just a really distorted risk premium. Not even with ETFs, but all the risky stuff is starting to go to private credit now. Can we really use corporate credit as a signal anymore, as in the way it once was?
It's a fair question. Listen, you're right. A lot of the risk has moved to private balance sheets, doesn't get marked to market. Does that leave higher quality or lower quality stuff for the public markets? We can debate. I think the investment grade credit market is a little less affected by it. So I do think it's a kind of a chicken and egg question, right? If the equity market goes down 20%, or there's credit going to be wider, of course. Will it be caused by the credit market? I don't know this time around. Again, I think investors are happy to buy the extra spread and the yield you get from treasuries plus corporates. And I think there's some logic to be said. I don't need to own treasuries. There's not a lot of upside to doing so. Your duration question earlier. So again, we're tight. Credit spreads are tight. I think they'll get tighter. Listen, if it gets disorderly, if 10-year notes are 5.5% in 6 weeks, it'll be a different story. But if it moves in an orderly fashion, I think that's where we're going.
Brian, we're going to hear from Jay Powell today, and you started the conversation saying that December might be the last cut, and maybe no cuts next year. Could we see hikes next year?
Listen, it's fun to talk about. I don't have a great. I don't think I could sit here and lay out for you exactly how we get there. In other words, if inflation runs 0.2 to 0.3 instead of going back to 2, is if they're going to go right back to hiking? I don't think so. So I think it's possible. I think it's more likely that they just want to sit here and let government do the work. That they can say, listen, maybe we'll say 4.5% looks more like neutral than we thought. Right? Could it be 4? Sure. I still don't think it's 5. So hikes would require all of these things to happen, tariffs to be super inflationary, but still pro-growth, and equities making new highs again. It would be. I could tell you this story, but I don't sit here thinking about rate. I don't want to bet on a rate hike in September as my base case.
You don't want that to be the headline, Brian. No. Don't worry, it won't be. It'll be something else on credit. Brian Wisden there of Morgan Stanley. Brian, appreciate the update, sir. Thank you. Speaking of 4.5%, very close to that level at the moment on a 10-year as we speak. We're up by 2 basis points, the 10-year 4.48. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Meta has been hit with an $841 million fine from European Union regulators. It's a small fine for the tech giant, but its first ever penalty for EU antitrust violations. The European Commission has ordered Meta to stop tying its Facebook marketplace service to its sprawling social network. Meta was also ordered to refrain from imposing unfair trading conditions on rival secondhand goods platforms. The company has vowed to appeal the decision in court, a process that could take several years. Meanwhile, Capri shares are lower and Tapestry shares are rising more than 8% in the pre-market after the fashion companies agreed to call off their $8.5 billion merger. They're saying it was in their best interest since they were unlikely to get regulatory approval before the deal was set to expire in February. Tapestry, the owner of Coach and Kate Spade, had wanted to join forces with Capri, whose biggest brand is Michael Kors. But a court blocked the deal after the FTC opposed the merger on grounds that it would harm competition in the market for affordable luxury handbags. And ASML shares are higher in Amsterdam trading after announcing it's maintaining its bullish long-term outlook. The chip maker projects sales in 2030 to range anywhere from $46 billion to up to $63 billion. That's according to a statement issued as part of its Investor Day taking place today. The announcement is a relief for investors after ASML's order intake took a hit in the third quarter, falling well short of analyst estimates and triggering a big sell-off in the stock last month. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead, looking ahead to Chairman Powell at about 3 p.m. Eastern Time, and we'll catch up with a familiar face. The latest from Bramo after the commercial break.
think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Equity futures right now just about unchanged on the S&P 500. Some developments in the bond market, though. PPI came in just a touch hotter than expected. Jobless claims came in just a bit lower than expected, and that unlocked higher yields again, just for a moment, by a basis point or two on a 10-year. We're back to about 4.47. As we count you down to the opening bell, here's the trading diary. The week ahead, the calendar shaping up as follows. Today, we get Fed speak from Powell, Barkin, and Williams. Tomorrow, some retail sales data. A sneak peek of earnings next week. Tuesday, Walmart. Wednesday, the big one, NVIDIA reports. A quick programming note for later today as well. Lisa sitting down with the JP Morgan Chase chairman and CEO, Jamie Dimon, at the APEC CEO Summit. I'm pleased to say that Bramo joins us now for more. Lisa, good morning to you. What's coming up a little bit later?
Buenos dias, Jonathan Farrar. I will tell you that it is so interesting to be here at this moment with APEC, given the fact that right now you have the Chinese influence very dominant in a country with a long history with China. I am going to be speaking with Jamie Dimon later today. Key question, obviously, is what do you think of the election? What has the response been from the companies that you speak to? But beyond that, there is a real vacuum here of power. We've got Joe Biden coming here today, but he is a lame duck president at a time where there's a real question mark, John, about just what the trade relationship will be between the U.S. and other countries at a time where China clearly is being aggressive, trying to make inroads with a whole host of nations, particularly if they have precious minerals like what we see right now in Peru.
And Xi Jinping and Joe Biden will be sitting down with each other on Saturday, Lisa. I'm sure that agenda list is very long, but to your point, with Biden showing up as a lame duck, how much inroads is China making on the global stage?
This, to me, is honestly the most interesting aspect of these meetings, because what I'm hearing from trade ministers from all around the world, particularly in Asia, is they are seeing direct investment from China, particularly when it comes to technologies, particularly when it comes to, say, copper here. They're opening a new port. They're christening a port. Xi Jinping is here to celebrate the opening after 10 years of work, and this port is going to shorten the time for goods to be transported from Peru to China, to Asia, by some 10 to 15 days. It really shows how China is trying to lock up some of those economic ties at a time where it's really unclear what the U.S. relationship is going to be. And really what I hear from trade ministers all over the world is this question to U.S. companies. Are you going to be investing more here? How are you going to be investing? And are you committed at a time where policy is a bit more ambiguous?
Lisa, I'm really looking forward to your conversation with Jamie Dimon, especially because you sat down with him a month ago. I wonder what some of the changes we might see in Dimon, especially, I remember him telling you that the U.S. is becoming anti-M&A. Are you going to get a much more bullish Jamie Dimon this time, you think?
That's a great question. We are going to address that. How much are the floodgates open? We did hear about that from the Citigroup CEO, that basically it's game on in the M&A market. I'm very curious to see how big the pipeline is, how much companies are saying, let's expedite this, let's get it all ready so that we can really hit the ground running early next year. But this is a real question. How much does this revive some of the animal spirits that we see from companies that have been waiting for some certainty before investing? And frankly, he is in the position to really have a sense of that. And right now is the moment. I do get the sense from people here that there is really a clear sense of start making investments now. Certainly you're hearing that from China, and I'm sure from U.S. companies, they feel that as well.
Gracias, Bramo. Mucha suerte. Thank you. I think that's right. Or is it buena suerte? What is it for good luck?
Muchas gracias.
Thank you.
Buena.
Thank you. Buena suerte?
Yeah.
Thank you. Not a
You
lot
got
of
it the
luck.
second time around.
Okay, we got there eventually. Coming up next, tomorrow morning, Andrew Sheets in English of Morgan Stanley, Matt McGuinness of the Committee for a Responsible Federal Budget. Looking forward to that. Phil Camporelli of JP Morgan, and we'll speak to Steve Risciuto of Mizuho. Do not miss that conversation with Jamie Dimon a little bit later. If you do, we'll play some of that for you tomorrow morning, and we'll catch up with Lisa later on in the program. From New York City this morning, good morning to you all. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special NITO ATP Finals update for Bloomberg TV and Radio from Tennis Channel. I'm Andrew Guy. Carlos Alcaraz put his first win on the board as he took out Andrei Rublev to keep his hopes of reaching the semis alive. The reigning Roland Garros and Wimbledon champ lost his opener to Casper Ruud, but held his nerve in the second set breaker to close out the Russian. Alcaraz will make the Final Four if he wins his last group match against Alexander Zverev on Friday.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
We want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating. And then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
In case you missed it, on Bloomberg Technology.
We're excited to really change the expectations for space companies, where you have this always-on, reliable, and frankly dynamic satellite connectivity that you would expect of your power grid or of your cell phones. And so we think that this is a huge opportunity space, and our first contribution to it is through shared infrastructure.
You can see this whole ecosystem developing, and you have an exponential growth right now because
easier access to space means more demand for space, and that's the definition of an exponential growth function. So if you think about someone like Varda, who is only possible now because access to space is cheaper and easier, we're demanding more access to space.
I think that's what's so exciting from a business perspective, is the fact that if you can do it, you're one of the few numbers of organizations in the history who've actually pulled it off. And so it creates a very defensible position, because again, space is very, very hard.
Don't miss Bloomberg Technology live every weekday.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Futures are a little changed, but politics is going bonkers, and inflation comes in hot. 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Shanali Bassick.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, fresh eco data, Trump's agenda, and more earnings rolling in. Morgan Stanley's Mike Wilson is going to share his playbook.
Disney delivers. The entertainment giant posts streaming success thanks to blockbusters like Inside Out 2 and Deadpool and Wolverine.
And a fashionable deal dissolves. Capri calling off its merger plan with Tapestry following regulatory hurdles. All of that and more coming up. But let's take a look at where markets are trading 30 minutes until the bells ring. It's pretty quiet. The S&P 500, it changed pretty much, it closed at unchanged levels yesterday. You take a look at where we are pre-market, even after that hotter than expected PPI data, and we're maybe a little bit lower, but pretty much dead even. You take a look at the NASDAQ 100, your big tech names, a little bit more movement, but down just a little bit. And even the bond market, pretty quiet right now. Of course, we had some intraday movement after that PPI data came out. We also had initial jobless claims, but you add it all together, the 10-year Treasury yield currently hanging out at about 4.45%, Matt Miller. These are very high levels.
Yeah, but so calm after PPI comes in 50% higher than the market had anticipated, at least on the core monthly. Look at this chart. I thought we rotated into a broadening market during the summer, but this is the S&P 500 as it's weighted, right? Mostly Mag 7 stocks, and this is the equal weighted index. Huge divergence. I'm going to ask Mike Wilson what this means in just a few minutes.
Sometimes stories just never change. I'm excited to talk about that as well. Let's look at some stocks to watch, because here's a story that's changing. Disney surging after posting fourth quarter sales that beat estimates. They're forecasting earnings growth for the next 3 years. Take a look at Disney, now up almost 9% pre-market. People like what Bob Iger is putting down. Meta, on the other hand, down more than 0.4% right now. It is lower after getting hit with an $841 million fine from EU regulators over antitrust violations. I am also keeping an eye on Capri and Tapestry. They are moving in opposite directions after ending an $8.5 billion plan to merge. Capri is now down almost 6%. Tapestry up more than 8.4%. Matt, we'll take a look at that. I have wondered if this deal would come back in the next administration. This was an antitrust story, after all, at the beginning.
Yeah, I love that story. I mean, I shudder to think how much money Tapestry has paid to finance this deal, and now to throw it all away in the face of an FTC with a boss who's so likely to get fired by the beginning of next year. It just, to me, feels like Tapestry is walking away because they've had enough, and it's too expensive for a stock that's just plummeted.
Yeah, it is really interesting that even though there is all this optimism that we're going to have a more favorable regulatory environment next year, that you're going to see more M&A, that Tapestry just couldn't hold out. Now they're buying back all the bonds as well, and just not the confidence that they could close this deal by February 10th. It's just fascinating.
They have to buy back the bonds at 101 cents on the dollar. I think that's a little interesting, just that baby little premium. The reason I think it's interesting is if they go back at this deal again, interest rates are not seemingly going down that much. Refinancing into a deal market next year might not be as easy as people think.
Well, let's talk about rates, and let's talk about it in the context of the PPI data that we got this morning. For more, let's welcome in Mike McKee. He is our Chief Economics and Policy Correspondent. And Mike, actually, when it comes to the PPI data, I want to go to this note from the BLS that over 1/3 of the rise in the index for final demand services can be traced to prices for portfolio management. Break that down.
This is the pogo trade. We have
Yeah.
met the enemy and he is us. We are seeing so much trading going on that the portfolio management category of PPI final demand goes up 3.6%, a massive increase. And according to the people who calculate all this stuff, that means a big rise in the PCE when we get that at the end of the month. And that's going to worry the Fed a little bit. Now, you take a look at the overall numbers, and I go back to Grant Williams saying things that make you go, look at the trend here in inflation, both for CPI and PPI. It's telling you that, at least at this point, we have stalled out above the Fed's 2% target. Does that change? That'll have we get another couple of numbers before the next Fed meeting. That'll have a big impact on what they do. And then, of course, jobless claims fall to 217. It shows that the labor market is still very, very loose or tight, rather, and we have pretty strong labor market. You can't see any movement in that line after we get down from the pandemic. It looks at this point like we're still employed and we're still making money and we're still going to be able to spend it. I mentioned the calendar coming up, though, guys. Retail sales tomorrow. We'll see if all that money translates into additional spending. And then we get the PCE numbers at the end of the month. November jobs, December 6th. Another CPI, December 11th. And then the Fed meeting is December 18th. So mark your calendars.
All right. That was a reference to a song from 1991, CNC Music Factory.
I was obviously born by then, but
Did
I still
you?
don't know what you're talking about.
No.
I was not alive, but it sounds like a great song.
Yes.
Mike Wilson, you.
That's in my wheelhouse, 1991. Yeah.
That's your time. Hey, Mike McKee, thanks very much for that look at the economy that's set up in terms of inflation. Mike Wilson, welcome to the show. Thanks so much for joining us. Chief U.S. Equity Strategist and Chief Investment Officer of Morgan Stanley. I wonder about your take on these markets in general. Step away from the politics. Step away as much as you can from the economics, and just look at the level on the S&P. I mean, 6,000, and I think your middle of the year target for 2025 is still 5,400. Don't we now, in the face of a second Trump administration, just march higher and higher on stocks as he deregulates and cuts taxes?
Yeah, we had 6350 in our bull case, and we kind of talked about that in the last time we were on the show, and I think the other ones, but that we thought if a Republican sweep occurred, which was the most likely outcome, we could probably trade 6,100 probably before year end. So we're right there. Can we get higher than that in the near term? I think it's going to be hard, but yeah, we're marching higher. I mean, this outcome was unexpected 4 or 5 months ago. And as usual, the markets figured it out, right? So in September, we pivoted more cyclically. We got a little bit more constructive on the index for these reasons. And the animal spirits activity, I mean, goes back to what Mike was saying about CPI, PPI. We had the same problem a year ago where, like, when the economy gets going, you get velocity in the economy. That's the thing that can probably hold us back, is if rates start to back up again on concerns, or starts to interpret maybe the Fed can't cut as aggressively, and then the multiples have to come down. But it'll be a stair step, right? We'll get pullbacks, probably be bought. It's a little euphoric right now. We'll have to have some consolidation.
Mike, we still reach 6,000 with rates relatively high. And when we claw ourselves out of earnings season, have you liked what you've seen so far, such that you could even raise expectations into next year? Where's the risk?
Yeah, well, I think the risk, and we've talked about this, it's not a risk, it's an opportunity, is that it's broadening out now. Finally, after 2 years, we're finally starting to see a broadening out in the broader economy, and that translates into better stock performance for the average stock. So the market's speaking.
Wait, did you see my equal weighted chart?
Exactly, but the market's speaking loudly. The one chart that you probably haven't looked at, which I think is the most kind of bullish confirmation that there's a real change at foot, is that gold now is underperforming the stock market. So for the last year, gold has actually outperformed the stock market, and that to me is a sign that the real returns have been sort of muted. And so in the last week, the S&P divided by the gold ratio has gone up by almost 12%. That's an interesting development to me, and it signals that maybe this political change does have lasting implications for what I've been talking about, is this crowding out of government in the private economy. And the government can be shrunk, which is what they're talking about. Then maybe the private economy can blossom. And that's what the market's trying to sniff out. It's not going to be a smooth ride, so there'll be fits and starts, but that's kind of how we're thinking about it.
A lot to dig into there. We've definitely looked at both of those asset classes, but in isolation. Our producer's working on getting that chart. But let's build on what you're saying, that if the government can shrink, maybe the private economy can blossom. Is that a base case? I mean, do you think that that will actually happen and you can invest around that?
Well, I think you have to start thinking about it. I mean, the market's already going there. So the question is, do I want to join what the market's telling me? I think you have to have a foot in that, at least one foot in that area. And that's what we did in September. We went to sort of quality cyclicals led by financials. That was the real sector that we got behind. But it also includes things like industrials, some small caps. Like we haven't gone full in on small mid caps only because rates are still too high. And now with this question mark around inflation again, that's harder for us to get like uniformly bullish on smaller businesses. That doesn't mean that smaller businesses can't do better. It's just going to be more idiosyncratic.
So I feel like, did he say his bull case was 66.50? So does that mean
higher?
63.50 was our bull case for May of next year.
But do you want to make that now your base case and give us a new bull case?
Well, we're working on that right now. You'll have to stay tuned because we can't talk about unpublished targets. But look, directionally, the market's already gone there. We've been kind of joining in that call for quite a while now, 3-4 months. And like the more important call, just to be clear, the more important call is not the index. We've said this for a while, is being in the right parts of the market.
True.
And like this year, we've navigated that pretty well, probably I think better than most in terms of being somewhat more defensive in the summer. We got the growth scares, and then we pivoted more cyclically as an example. That doesn't mean we get everything right, but that's what portfolio managers are really doing now. You got to be in the right places. It's not about just owning S&P. We got to beat the S&P.
I remember when you said that on Surveillance in April.
That's right.
Yeah.
That's the game.
Well, stick with us, Mike. Of course, we're going to get to the good stuff next, the politics in the markets. Anyways, we are going to talk about that. But coming up, Gates and Gabbard. We're going to bring you the latest on President-elect Trump's cabinet and what Senator John Thune's leadership means for the Trump agenda. That's up next. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Well, President-elect Donald Trump shocked Washington with his decision to nominate loyalist Matt Gaetz as his Attorney General. Former House Speaker Kevin McCarthy, who was toppled by Gaetz last year in a rebellion by ultra-conservatives in the GOP, spoke about the odds of Gaetz's confirmation.
I think choices are very good except one. Look, Gaetz won't get confirmed. Everybody knows that. It's a good. How are you reading? It's a good deflection from others, but Gaetz couldn't win in a Republican conference, so.
The announcement of that nomination just capped a string of other controversial picks from Trump in the past 24 hours. Joining us now is Bloomberg government reporter Kate Ackley in Washington. And Kate, building off of what we heard from the former House Speaker, the confirmation process, I mean, is that something that you're hearing broadly when people are talking about all of these picks?
Right. I mean, a pick like that is subject to Senate confirmation. All the cabinet level positions are subject to Senate confirmation. And so the question is, how deferential will this incoming Senate Republican majority be to incoming President Trump of the same party? Will they be completely deferential? I think former Speaker McCarthy makes a good point. It may be very hard to get someone like Matt Gaetz confirmed through the Senate. And that's why you've seen some speculation and even President-elect Trump talking about recess appointments as a way to get members of the cabinet installed when the Senate is in recess. That is not necessarily going to be what the Senate allows. And, Senate Republicans yesterday picked their new incoming leader, John Thune. We sort of referred to him in our coverage as the old guard. This is somebody who's been in the Senate 2 decades, more than 2 decades, will be sort of using the rules of the Senate and being that likely the check and balance that the Senate is supposed to be on the executive branch.
Yeah, that check and balance key at a time when, a lot of these nominations, I think Matt Gaetz said he wants to ride or die with Donald Trump. So if the president goes down, he's willing to bring the rest of the country down with him. Is that the same for Tulsi Gabbard, for Pete Hegseth? I mean, are these picks serious? Are they going to go through?
Well, there's speculation that maybe these are, the incoming president picking some loyalists and doing favors for people that have stuck by him, helped him in the campaign, that maybe there will be other picks forthcoming and they will look more palatable to the Senate and the American public by contrast. But, he is the president-elect, and there were senators, and I think you've had some on your shows, who have said, he won. He has a mandate, he won, it seems, the popular vote as well as the Electoral College. So how much deference do senators and, other officials give him to pick the people that he wants? That's the question.
Certainly interesting to watch that push-pull between the Senate and the White House. Kate Ackley from Bloomberg Government, we thank you so much for your time today. Mike Wilson of Morgan Stanley still with us. And before the break, you were talking a little bit about what it would mean for the government to become more efficient. That seemed like a little bit of a nod to the Department of Government Efficiency, DOGE.
That's right. I mean, of all the appointments that I've seen so far, that's the one that offers, I think, the most interesting potential upside. Because we knew that President Trump would be tough on immigration, okay? So the appointments there don't surprise anybody. We know that he's going to be tough on tariffs, all right? So that's not new news. What's new news is how serious are they actually about trying to make the government more efficient? You bring a guy like Elon Musk and Vivek Ramaswamy into this program. I mean, these are serious business people. And so I think that's exciting. It's going to be a tough road. I mean, our House view is it's going to be tough to actually cut spending. Hey, let's start with freezing spending. Let's try to small wins here. So that's what I'm really focused on, because from an equity market standpoint, that's the potential for much more upside. Not at the index again, but for the average company. If we can get the government sort of out of the hair of the entrepreneurs in America, boy, that's kind of an exciting story, potentially.
Well, Mike, let's go down this road. Let's build that hypothetical path. Let's say that DOGE is successful, that they manage to freeze spending, cut back spending. improve efficiency. What does that mean for the economy, and what does that then mean for the stock market?
Well, that's the tricky part too. Is that this? I mean, look, this is a Herculean task. Okay, it's been tried before, by the way, and it's run into roadblocks. In fact, I think in Trump's first presidency, they tried to go down this path, kind of gave up in the end, and the government continued to expand. So, because it's exhausting. So it's going to take time, and the path from here to there probably means slower growth in the short term, right? If you shrink the biggest growth driver, the government, what does that do to the overall economy in the short term? So there's a lot of unanswered questions. We have no details, as usual, at the beginning here. But once again, this is an area where we're very focused on, and we're going to have to key off headline announcements, and then we're going to see what they can actually get done, whether it's the first half of the year, second half of the year, how long it takes to play out. So a lot of unanswered questions, but to me, this is the potential for a big surprise where we have to be open-minded to.
I mean, the question is, which we won't answer here or this year or next year, does Donald Trump care about his long-term legacy enough to risk his shorter-term reputation? I was looking at a chart that our producer in London, Daniel Curtis, gave us this morning, showing that stock and bond yields have hit parity. And I was thinking, with the policy uncertainty, do you go into Trump 2.0 with a stock portfolio, or is it safer to bet on bonds?
Well, going into the election, we felt like this is the outcome, that basically if Trump won in the Republican sweep, that stocks would do better than bonds, and that's basically played out through the fall. So the question is that fully priced now? In the short term, it probably is priced, meaning we got the easy part of that trade is kind of behind us, and now it goes to the stock level. And clients that we speak to are in the same boat. So initially what they do is they buy futures because I don't really know what to do exactly. And now what they're doing is they're just topping off existing positions. So if you look at crowded positions, they've continued to do well. It's like continued momentum on that trade. But then as we get into December, people will start thinking about next year. And that's where we take a break. We'll take a break, and then we'll have a new theme, a new idea it's totally away from politics, right? The market needs a new idea, a new theme to gravitate to, which, by the way, is one of the reasons why we're seeing some of these crazy moves in, speculative areas, right? People are making money in crypto, as an example, and then they're funneling it into like the next hot story they're hearing about on the internet, or they're from their best friend or whatever. That's a little frenzied at the moment.
Well, when we think about the stories of next year, you think a lot about taxes, and the debt to GDP ratio today is not the same as it was back in 2016. The tax cuts, or at least the extension of the 2017 tax proposals here, do you think that now that we have a red sweep is just a sure thing, or is there some discipline there to keep some of that from rolling off?
Yeah, and do they lift the SALT cap and make it retroactive very early next year?
Well, the retroactive isn't happening, and I wish. But what I would say is, I think you're totally right. We've written about this too. This is not 2016. We don't have the slack in the balance sheet or in the economy itself, in the labor markets, particularly if we're going to reduce immigration and deport some of the folks that are here. We don't have that slack. So if they try to really push the envelope on increasing spending and reflating, inflation is going to become a problem really quickly. So they have to be careful about balancing, okay, we're doing some cost cutting, that's great. Maybe then they could cut taxes a little bit, but I think you have to do more. Like I would freeze taxes. I would maybe extend the TCJA and then call it quits. But I'm not in government. But I think that the markets will respond much better to fiscal discipline on both sides, both taxes and spending, as well as entrepreneurially favorable policies.
Well, the good news is that you can tweet at Elon Musk. He's welcomed suggestions coming online. Mike Wilson, it is always a treat to speak with you. That is Mike Wilson, of course, of Morgan Stanley. Now, coming up later today, JP Morgan CEO Jamie Dimon speaks with Bloomberg's Lisa Abramowitz from the APEC CEO Summit in Peru. You can catch that conversation at 2:30 p.m. Eastern. This is Bloomberg.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live every trading day. Balance of Power live around the world every weekday, only on Bloomberg.
Welcome back to Bloomberg Open Interest. Let's take a quick check on futures right now. 5 minutes until those bells ring. It's pretty quiet, but to the downside. The S&P 500 slightly lower so far. You can see that big tech, more of a direction there. That was the setup yesterday. This is basically how we closed yesterday afternoon, and we're holding that in the pre-market. The NASDAQ 100 down about 0.2%. The Russell 2000 also declining yesterday, up a little bit pre-market on the Russell 2000, currently higher by about 0.2%. And it was interesting in the conversation with Mike Wilson. Sounds like he's pretty neutral on small caps versus the rest of the market there. And then I think back to your equal weight chart. I mean, it has been interesting, the outperformance at the size level when it comes to the small and the equal weight, but how sustainable that is, I think that's where people start to waver.
Yeah, and I also didn't realize, I was just last night reading a story from this summer when equal weight, hit a new record high. So I didn't realize we'd seen that huge divergence, but maybe we see a rotation trade again.
There are a lot of investors who want it, right? Steve Whiting at Citigroup was pitching S&P 400 as well, but let's see where it goes. At the end of the day, the S&P 500 has still sustained in and around 6,000 for a while. Anyways, less than 4 minutes to the opening bell. We'll discuss the market moves with Steve Chevron, Federated Hermes, head of multi-asset. This is Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
We are moments away from the start of trading on this Thursday. This is Bloomberg Open Interest. I'm Matt Miller. Not a lot of movement in terms of futures. After the S&P came up through that 6,000 mark, we haven't really moved far off it, as Shanali was just saying. Right now, unchanged on futures. NASDAQ futures down 1/10. Russell futures up about a third. You hear the opening bells, and on the New York Stock Exchange, you have Veris Residential celebrating its 30th year of listing. In those 30 years, they have underperformed the Bloomberg REIT Index by 1,000%. Over on the NASDAQ, BeyondTech is ringing the opening bell to celebrate its 5-year anniversary of listing on the NASDAQ. In those 5 years, they have sextupled their stock, more than tripling the gains on the NASDAQ. So they've done a little bit better. Katie, what do you see in terms of the averages?
Yeah, story of have and have-nots there, but everyone's clapping all the same. You take a look at this market right now, not too much to get excited and clap about. You have the S&P 500 a little bit higher in the first few seconds of trading to the tune of about 0.1%. The same thing if you take a look at your big tech index in the NASDAQ 100, higher by about 0.1%. Small caps outperforming once again. You can see the Russell 2000 currently higher by about 0.4%. This was your underperformer yesterday. It's been really hot and cold, but over the past month, it's been all small caps. Now, taking a look under the surface, a really fascinating story here. Capri and Tapestry showing big moves after walking away from their $8.5 billion planned merger. A U.S. court had frozen the deal due to antitrust regulators' objections, and now you're seeing, of course, it just fall apart completely. Interesting, Capri going down a little bit, but Tapestry higher to the tune of about 8%, Shanali.
Katie, I'm just keeping an eye over here on Meta because it was fined $841 million by EU regulators for antitrust violations related to its Facebook marketplace service, and you're now seeing Meta down about 0.7%. It's been fluctuating between 0.6 and 0.8, Matt.
Yeah, Meta Platforms is interesting. A lot of individual movers that are catching our eye today. Advanced Auto, for example, erasing its pre-market decline after results missed estimates. It did announce plans to close about 500 stores and cut jobs, and typically markets appreciate it when you do that. There are obviously different individual circumstances, but in this case, Advanced Auto up 10% at the open. Another stock we're watching, and this to me is one of the most interesting stories on the day. Disney didn't just beat expectations on profit and sales in its fiscal fourth quarter because it had big movie hits like Deadpool and Wolverine.
My favorite. Inside Out 2.
Inside Out 2, which I still have not, well, I have not seen either one, but I thought it was amazing. Disney forecast profit gains going out 3 years. And they don't typically give long-term outlooks. So they're saying double-digit profit growth in 2026 and 2027. As a result, the shares are up the most since February, and we're joined by Geetha Ranganathan of Bloomberg Intelligence to talk about this. So what is the deal with Bob Iger, Geetha, you know, going out on a limb here and promising something in 2027 to shareholders today?
Yeah, absolutely, Matt. I mean, the empire strikes back, right? Really big time. And it's really been, the biggest gripe, I think, for Disney investors has kind of been this lack of clarity around some of the businesses. There's been this theme park softness. We know that streaming has finally turned a corner, but we really didn't have much visibility in how those profits, how those margins were going to pan out. Remember, they do have to chase Netflix there, which is the leader with, over $10 billion in profit. And then you have the movie turnaround, which has again been in progress, but them laying out things for us so clearly, line item by line item, really inspires a lot of confidence.
Speaking of confidence, want to touch on streaming just a little more there, because what's fascinating to me is, yes, they may have to catch up to Netflix in a larger way, but we have seen many enter this world and fail. So is there a moat that they can create in certain businesses, given they both have Hulu and ESPN, which has the holy grail of sports?
Oh, absolutely. I mean, we've seen them already kind of do that in a way, Shonali, with Disney Plus. Remember, they have, the studio, the performance of the studio is so important, not just for theatrical and box office numbers. And remember, they've generated $3 billion at the box office just from Inside Out 2 and Deadpool. But it's those movies coming to the streaming service that again kind of sparks those subscriber numbers, and we have a really stellar slate kind of lined up both in fiscal 2025 and 2026, and that's going to keep that streaming momentum going. So yes, you do have a business here with a lot of scale. Remember, ESPN Plus is also profitable. I mean, all of the businesses now are profitable on the streaming side, and then with ESPN, really the big thing that we're watching is the launch of a standalone streaming product in 2025. And again, they are hoping that kind of really boosts, streaming profitability over time as well.
Well, anyway, you slice it, a needed shot in the arm for Disney stock. Now up 25% year to date with today's jump. Geetha, really appreciate your time. That is Geetha Ranganathan of Bloomberg Intelligence. And later this afternoon, Disney CFO Hugh Johnston will speak to Bloomberg about the company's strong quarter. You don't want to miss that one, but keep it here, because right now we're going to broaden out this conversation with Steve Chivarone. He is Federated Hermes head of multi-asset solutions. And Steve, I want to bring you some breaking news. This from Crane, showing that U.S. money market assets surpassed $7 trillion for the first time. ICI data isn't too far behind. And you marry the fact that there is so much money sitting in money market funds, and you have a market that's pretty much at all-time highs. How does it make sense?
So we have insight on this. Federated Hermes, we're a leader in the money market business. And what you see is a lot of those money market assets are not necessarily investable assets. This isn't cash that's going to be put into stocks or bonds. What you've seen and what you're continuing to see is that money markets in many cases offer better yields, a little longer duration, and a much better deal than traditional bank deposits. So you're seeing this money that's been in bank deposits. When rates were zero, it could sit there because it didn't matter. Well, now, rather than getting 0% in a bank deposit, you can still get a high 4% yield in money markets, and that's really attractive. And we think that's going to be attractive for some time. So it's a different pool of money. That's really cash. What you see on the equity side, I think, is we're seeing a rotation from the dominance of big tech and large cap growth, and we're starting to see other parts of the market perform, particularly small caps.
Obviously money markets are a different thing than just straight treasuries, but I saw a chart this morning showing that stocks and bond yields are now at parity, and I was thinking, which is the better bet going into Donald Trump 2025? Do you want to own stocks at a time when he's likely to deregulate and cut taxes, or do you want to own bonds at a time when he could put on tariffs and do mass deportations? How do you think about that trade?
I think you want to own stocks. I think that if you look at the sum total of his policy set, and you're optimistic, it's pro-growth. If you're pessimistic, it's inflationary. I think it's probably a little bit of both. I think it certainly is pro-growth. I think lower taxes are pro-growth. I think deregulation is pro-growth. Tariffs can be inflationary if they're implemented. If they're used as a threat to encourage re-onshoring, that can also be pro-growth. But one way or another, it looks, and the market has priced in the last week and a half, that a Trump presidency is bond unfriendly. We've seen 10-year yields back up, and we think they'll get above 4.5%, but it's equity friendly, and it's particularly friendly for cyclicals, companies that are U.S. focused, and small caps, which are both cyclical and U.S. focused. And remember, small caps have to comply with 100% of the regulation with only 10% of the revenue. So on a dollar for dollar basis, they really benefit from deregulation. So we think it's clearly a stock story.
Speak more to that. Matt made out this great point a little earlier, that if you invested in the S&P equal weight, you're really lagging as of late when you compare it to the S&P 500. It's not true for the Russell 2000. You're seeing a lot more love there. And the Russell 2000 is actually outperforming since the beginning of November, even the NASDAQ 100. So how much money do you put to work chasing that trade?
So across our multi-asset portfolios, our two biggest active weights are an overweight to small cap and an overweight to cyclicals. When you think about that equal weighted S&P 500, remember, you have growth stocks, but then you have value, which is really two communities of stocks, right? There's your cyclicals, which are economically sensitive, which do well in a higher rate, higher growth environment. And then there's your more defensive dividend payers that generally don't do as well when you've got a 10-year yield moving up as much as it has. And so, to just be as simple as to say, well, I'm going to own the equal weight versus the market cap weight, we think you got to be more specific. You need to do some stock selection. And so when we look out, we look at parts of the market that are not at all-time highs, that are not trading at kind of really stretched valuations, and that have earnings growth that's inflecting higher. And you see that in small cap, both growth and value. You see it in financials, you see it in energy, you see it in parts of industrials, you see it in parts of materials, you see it in consumer names, not named Amazon. And that's where we're allocating capital. And if you look, that has been working over the course of the last few weeks.
Steve, really quickly here, I want to finish on small caps and talk about whether or not there's a FOMO trade going on, because Bloomberg Intelligence has some really great data that if you take a look at pure play small cap managers, a lot of them own mid caps. A lot of them own those larger names. They've been cheating up to juice their returns, so to speak. Now that we have small caps outperforming, a lot of people expect that will be a sustainable path forward. Do you think that we could see a lot of managers come back into small caps in a big way?
I think you can and you will, and I think this demonstrates the importance for clients out there to choose strategies that are style pure, that deliver what they're designed to deliver. Whether it's rates falling, that helps small caps. A steeper yield curve where you're seeing short rates fall but long rates stay high, that's good for small caps because most of their debt is floating rate debt based on shorter term rates. Earnings growth, they're going from negative 16% earnings growth this year to positive 40 next year, and they're 2 standard deviations cheaper than they normally are. So for a lot of reasons, we think that this trade has legs, and we think if you want small caps, then you need to own actual small caps.
That's what Katie wanted to hear.
Yeah, all right.
We love the small caps here.
Perfect.
All right, Steve, thanks so much for joining us. Steve Chevron there of Federated Hermes. Coming up, we're going to talk about the collapse of the Tapestry Capri deal. It was an $8.5 billion acquisition. More on why it's not going to happen next. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
This is Bloomberg Open Interest. A quick check on stocks because we've turned lower in the first few minutes of trading. The S&P 500, the NASDAQ 100 now down 2 to 0.3%. Even your mighty small caps falling prey here. You can see the Russell 2000 down about 0.1%. We'll keep an eye on that. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Barclays upgrading American Air to equal weight with a $16 price target. The analyst is expecting improving fundamentals and investor sentiment to drive a powerful rally for airline stocks next year. Next up, UBS raising its price target on Abercrombie & Fitch to $170 and maintaining its neutral rating. The analyst says that the brand's fundamentals remain solid. And finally, HSBC raising its price target on NVIDIA to a joint street high of $200. The analyst says that he still sees more AI-driven growth in store, Matt.
Yeah.
All right.
AI-driven growth is definitely coming.
Yeah, especially for NVIDIA.
And especially for those guys. Now, let's talk about Capri and Tapestry. I was trying to think of a segue, but I can't get from
No, that was okay.
artificial intelligence to mall-grade handbags. They have decided to mutually end their $8.5 billion merger. Of course, there's no such thing as a merger. It was an acquisition, right? Tapestry was going to buy Capri, and then Donald Trump won, tariffs are coming, the FTC said no way, and Capri stock was off 60%. Let's talk more about this with our deals reporter, Crystal C. She joins us here on set. So there's so many reasons that this ended up looking like a bad deal for Tapestry, and they're out.
Well, the FTC said no before Donald Trump came in.
Right, true. I should have said that was like earlier this year, and then they pushed out until February?
So a month ago, the FTC said no, but all along people have been saying that it's a very tough deal to get done. You probably wouldn't think that, and I didn't think that affordable luxury, like handbag, barrier of entry is pretty low, and it's a pretty controversial decision. And when
but Lena Khan wants to make sure there's competition in this handbag market,
there
right?
needs to be competition everywhere in the market, but
kind of get lucky. I mean, I hate to say that, but if you look at it, Tapestry just raised their outlook. They're doing pretty well. Capri's going to have some trouble. It looks like they have to cut their fleet of Michael Kors stores, and so look at the price of Capri now. I mean, it's meaningfully lower, as you were mentioning to us earlier. Is this a deal that maybe shouldn't have happened anyways?
The deal price was at 57. Most yesterday at close, Capri was trading at 18. It's been a really tough couple of weeks. Since the FTC decision came down, the stock have significantly dropped. But like you said, like, is it in hindsight a good thing? You have to bear in mind also that if you're in a merger talk, an acquisition talk, no such thing as a merger, as you say, you're probably putting a lot of things on hold. You're not thinking about improving your business, doing your marketing channel, and this is probably a good moment for all of that to come back leading up to the holiday season. Maybe they wouldn't catch this season, the next season. So this is, the company will have a call this morning at 11 to talk through their strategy, but now that they have to be an independent company, at least for now, they will have a lot of those, the strategies and like the improvement coming.
Yeah, definitely a call to listen into. And it's certainly telling that Tapestry shares are much higher this morning. What happens to Capri, though? Do they try to shop themselves out here? Can they survive without being bought?
So everybody who wanted to look at this brand would have looked at this brand throughout this 18-month ordeal of Tapestry trying to buy this company, not happening, all of that, right? So likely that you already smoked out the people, but then the price is key here. It's significantly a smaller price, so you could see people coming in and looking at it. And is it currently more vulnerable than it was 18 months ago? I think so.
It's a deal. It's a sale.
It's a sale. It's on sale for sure. Crystal, thanks so much for joining us. Crystal C. from our deals team at Bloomberg News. I'm sure we'll continue to talk about the breakups into the M&A boom. Coming up, Polymarket is catching the attention of the FBI and the DOJ. We'll take a look next in our Wall Street beat. What's going on with the crypto betting site? This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Welcome back to Bloomberg Open Interest. You're taking a look at stocks on the back foot right now. The S&P 500, the NASDAQ 100 a bit lower this morning. A drop in Tesla dragging down both indexes, currently off about 1.4%. It's a big company, though, and it's a big weight right now. The Russell 2000 also down a little bit, though. Small moves overall. Small caps down about 0.1%, Shanali.
And Katie, it's time now for the Wall Street Beat. Today we are looking at crypto predictions betting platform Polymarket. It is under investigation by the Department of Justice for allegedly violating its agreement with the Commodity Futures Trading Commission. Joining us with more is Bloomberg's Charlie Wells. And to put this all into context here, Polymarket, of course, has become very, very, very popular lately because of the predictions made into this election cycle. But of course, since 2022, since their agreement with the CFTC, it is to be that U.S. users cannot use it onshore. So what's going on? Put this all into context here.
Shanali, I'm just going to go out there and say and basically prediction markets in the United States are in sort of a puberty phase. So they're growing a lot, as you say. They're developing, but they're also going through some sort of awkward phases. And I think counting in that awkwardness is, a dawn raid by the FBI on the CEO of Polymarket. And as you say, a person familiar with the matter says that the company allegedly allowed U.S. users to trade on this market. That would be a violation of that 2022 deal that they struck with the CFTC. But it's a little bit confusing, right? Because there are other markets that are, taking off in the United States. We've got Kalshi as well. And, Kalshi, they allow election betting. And so according to a recent federal court ruling, election betting is allowed in the United States, but you have to be registered with the CFTC. Now that brings us back to Polymarket. Of course, they are not registered. They have that deal with the CFTC, but they do not have the same type of agreement. And the real rub here, I think the interesting thing, if you're looking across all of these different platforms and you want to know why there was that dawn raid on Polymarket, something that's really interesting is that U.S. financial regulations do not allow betting on things like wars, even on things like sports. So that's under financial regulations. So you can do that on Polymarket, but you can't do that on platforms like Kalshi.
So I know that the head of Polymarket said something like new phone, who dis?
That's exactly it.
Which is like, I'm practically a boomer because I love that. But what is Polymarket's actual response to this? Because they've dealt with this before. They knew this was an issue and they took steps to address it.
It feels like really good marketing for this company, to be completely frank, but look, they have said that they are going to defend themselves, they're going to defend their community. The company also said that they felt like this was politically motivated, right? We need to remember that just last week, it was the Republicans who did have that solid sweep in the election who were touting the likes of Polymarket, saying, of course, that they were more accurate than polls, and they ended up being that way. So you get this kind of defensive posturing. You say they're going to stick up for their community, and of course, you get the CEO now front and center posting kind of funny things on X.
All right, Charlie Wells, 30 seconds. What happens next? Where does this go?
Look, I'm going to take it back to that puberty phase comment I meant. I mean, look, these markets are growing. They have a sort of air right now of invincibility. In large measure, they beat polls in the last elections. So, you pair that as well with this rally that we're seeing in cryptocurrencies. On Polymarket, of course, you've got to bet with cryptocurrencies. You pair predictive markets with cryptocurrencies with the incoming administration, which embraced both of those things. And it seems like a positive direction for travel, but maybe some legal challenges along that route.
All right, Charlie, thanks so much for joining us. Charlie Wells there talking to us about Polymarket. I think new phone, who dis is what I text the most often.
I've never gotten that text, just saying.
What? Sometimes, hey girl, you up?
Please don't text me that ever.
No, I just don't answer texts. So.
Markets are not up right now. We've seen kind of a little bit of a crescendo, and they've been turning down. So we're going to keep you up to date on that. Still at a, obviously, relatively high level after crossing 6,000 this week on the S&P. We're going to talk about Brooks running shoes as well. And this is very cool because Brooks has a partnership with Disney that
just announced.
I just found out about it. So stay with us for that CEO interview. This is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? It's just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. Eyebrows raised all around over President-elect Trump's pick for Attorney General, Florida's now former Congressman Matt Gaetz. Correspondent Nancy Cordes.
President-elect Trump surprised even many in his own party with his choice of Gaetz for Attorney General, especially because the announcement came just 2 days before the House Ethics Committee is set to vote on releasing what CBS News has learned is a highly damaging report about its investigation into Gaetz.
Gaetz has also been investigated by the Department of Justice. The Senate's new leader, John Thune, is facing a full plate. CBS's Nicole Killian.
Thune will be tasked with managing the confirmation process for Trump's new cabinet picks. The president-elect has already called on the new majority leader to use recess appointments to expedite his nominees. Thune has said he prefers the traditional hearing process, but has also said all options are on the table.
A stubborn wildfire along the New York-New Jersey border is now 50% contained. CBS's Tom Hansen says crews are hoping to make more progress today.
They're going to be going out with axes, picks, shovels, anything they can use to try to carve a path through this bone-dry brush and really control where this fire goes. They're hoping that because there are no significant wind conditions today, they're going to be able to get out ahead of that blaze.
Sold at auction today. Conspiracy theorist Alex Jones' InfoWars. The buyer...
You're watching the Onion News Network. A hacksaw of news cutting through the gangrenous leg of ignorance.
In a statement, the Onion CEO Ben Collins says his satirical publication's goal is to end InfoWars' relentless barrage of disinformation and replace it with a relentless barrage of humor. No word on the selling price. Jones owes more than $1 billion for calling the 2012 Sandy Hook massacre a hoax. How do you feel about the death penalty? It may depend on your age. Here's CBS's Jim Krasula.
Younger generations of U.S. adults are far less likely than older generations to favor the death penalty for convicted murderers. As a result, overall support for the death penalty in the U.S. has fallen to 53% today, according to a new Gallup poll. That's a level not seen since the early 1970s.
Olympic downhill champ Lindsey Vonn is planning a World Cup return almost 5 years after she retired from a string of injuries.
2 ACLs, MCL, meniscus,
broken my wrist, my thumb, my pinky.
List goes on. Vaughn on CBS's 60 Minutes in 2018. 40-year-old isn't ruling out the Olympics in 2026. This is CBS News.
Wired.com.
Time to roll up a sleeve if you haven't yet.
The holiday season is approaching, so health officials say it's time to get vaccinated for flu and COVID-19 if you haven't already. Gear up with a flu shot.
Protect others and reduce your risk of being sick or hospitalized with the flu.
That's the message in a new PSA from the Ad Council and the CDC. CDC Principal Deputy Director Dr. Nirav Shah says get protected from flu and COVID-19 before we start gathering to celebrate the holidays.
A lot of us are going to be getting together with our families in small gatherings, going to church, going to other events. Those are situations that the virus thrives in.
Bradley Blackburn, CBS News.
We've learned the cause of death for Quincy Jones. A death certificate obtained by People and other media outlets notes the legendary music producer and composer had been living with pancreatic cancer for years. Jones died last week at his home in L.A. at the age of 91. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube as well, so head over to youtube.com, search Bloomberg Podcast. Alex Steele out today. She will be back Monday, I promise you. John Tucker, you get the nod here for this Thursday for 2 hours. How about that?
I mean, it was like a last-minute nod. It was like, hey, you don't look like you're doing anything.
There. Why don't you go on the radio for 2 hours?
Go sit down.
So we got John Tucker with us for the next hour, so we are in good hands along with Lisa Mateo. We're going to check in with Geetha Ranganathan. She covers Disney and all the big media companies for Bloomberg Intelligence. Disney had some good numbers. Mickey Mouse put up some nice numbers. Streaming's profitable. Stocks trading higher, so all good there. Margie Patel, Senior Portfolio Manager at Allspring Global Investments, will join us to give us her market outlook. Mike McGlone, Miami Mike, Bloomberg Intelligence Senior Commodity Strategist. We're going to talk to him about oil and Bitcoin. I'm looking at Bitcoin right smack on $89,000 per token. We did get up, pushing up against 92,000 earlier in the market. So lots of volatility, lots of movement in Bitcoin. But right now, let's kick things off with Lisa Mateo of Bloomberg Business Flash.
You got it on this Bloomberg Business Flash, brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/around-the-clock. All right, stocks ditching lower. This is after U.S. producer prices picked up in October. Now, a big part of that gains in portfolio management, other categories, and that was fed into the Federal Reserve's preferred inflation gauge. Also, applications for U.S. unemployment benefits, that fell to the lowest level since May. This all comes ahead of Fed Chair Jay Powell's speech later this afternoon. So we have NASDAQ, the NASDAQ down 0.2%, 49 points, but at 19,182. The Dow, little change, down about 40 points at 43,916. The S&P 500 down 0.1%, 8 points at 5,976. We have the 2-year yield, 4.26%. That's down 2 basis points. The yield on the 10-year, 4.42%, and that's down 2 basis points. We have the dollar stronger, Japanese yen weaker, 155.82 against the dollar. Euro, British pound weaker. And Bitcoin right now up about 0.5% at 89,000. That's after it topped 93,000. So I want to check quickly with Coinbase Global, some crypto-linked stocks. That's down just a fraction. And we have MicroStrategy. Well, right now that's up about 2%. To earnings we go. Walt Disney, their shares up about 8%. Film and studio streaming business drove earnings growth. You have Advanced Auto Parts. They're up about 8%. Posted net sales for the quarter, though, that missed estimates. It also plans to close about 500 stores. And this coming in, the satirical news site The Onion on tap to purchase the InfoWars website. And I have to give this quote from CEO. The Onion is proud to acquire InfoWars. We look forward to continuing its storied tradition of scaring the site's users with lies until they fork over their cold, hard cash. What? We will also accept Bitcoin. There you go. For
That's the best CEO press release ever.
Ever. Exactly.
4 hours a day. Subscribe to Bloomberg News Now wherever you get your podcasts. I'm Lisa Mateo. That's your Bloomberg Business Flash.
All right, Lisa Mateo, thank you so much for that. We appreciate it. We have John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Market Drivers today is brought to you by Wells Fargo Advisors. Consider Wells Fargo Advisors Financial Network, where you can run your business with true independence, supported by unrivaled resources. Learn more at WFA.com/resources. Got a little bit of red on the screen, as Lisa was just reporting. Not too much happening here. Taking a little bit of a break from the strong risk-on view we've seen since the election last week. Bailey Lipschultz joins us here. He covers all the equity markets for Bloomberg News. Bailey, what are you looking at?
Yeah, Lisa mentioned Walt Disney outperforming right now, up about 9%. Second best performer in the S&P 500, coming after earnings forecasts beat estimates and really ease some of those concerns, seeing a lot of strength across their streaming platform, an area that has been a key focus. Size and scope for the stock. Biggest single-day rally on an intraday basis since February, so still recouping some of those losses when you look back 3 years ago, still down 30% from those levels. So
they're given a long-term forecast too. Is that, they don't do that, do they?
That seemed new to me from my experience covering.
Is that like a Hugh Johnson thing?
Hugh Johnson.
Or the CFO?
Could be. I mean, we'll talk to Geetha Ranganathan. She's coming up in just a moment. But I just think they have a little bit more visibility, I guess, on the streaming business and the profitability. They finally turned the corner to profitability, and I think that's one of the big things the street have been looking for.
Yeah, and then to your point, JT, they see, looking at the release, double-digit adjusted EPS growth in 2026 and 2027. So I think that's kind of trying to just ease some of those concerns, to your point, Paul, from investors. And this, again, has been a stock that, when you look at how it's compared to the broader S&P 500, really has lagged, no matter how you slice it.
All right, we'll check in with Keith in just a moment. What else you got?
ASML rallying, the company that it provides tools for chip manufacturers like Taiwan Semi, Intel, and Samsung, maintaining their 2030 outlook. So looking quite a bit into the future.
What I'm doing tomorrow.
But this is coming after last month we saw the stock drop 16%. They wiped out about $57 billion in market value after issues with their near-term guidance. So maintaining those long-term targets, really talking about how they expect AI to continue to be a trail that they are going to be a big part of. When you look at the semiconductors index, ASML, fourth biggest component. So it's a very large company, north of $270 billion in market cap, and one of those key producers, and fits into that kind of ecosystem, again, with Taiwan Semi as well as NVIDIA.
All right. Anything else for us?
Capri and Tapestry deal is formally off after FTC blocked it.
Was it a regulatory thing? Or
FTC blocked it.
Okay.
So this is kind of
because they were afraid pocketbook prices would get too high.
Yes. Yeah, you've got the owner of Coach and Kate Spade wanting to merge with the owner of Michael Kors. There's some regulatory concern there. Part of the Lena Khan.
Well, bring that back in a few months, because what I understand, Lena Khan may not be at the Federal Trade Commission. He may be to get this deal through.
Yes, I think that's a safe bet.
Is that a safe bet?
Okay. Safe bet that she won't be there. But just looking at CPRI, Capri shares down 2.3%, trading at the lowest level since 2020. On the flip side, Tapestry at a more than decade high.
All right, Bailey Lipschultz, thank you so much. We appreciate that. Bailey covers all the equity markets for Bloomberg News. Let's get to that Disney story. Again, as Bailey was just saying, the stock's up 8.5%, some good numbers there. Geetha Ranganathan, she joins us, John. She's the U.S. media analyst for Bloomberg Intelligence. She's down in Princeton. Geetha, the street liked what they saw last night from Disney. What did you see?
What we saw, Paul, was a lot of guidance, and we've never seen guidance laid out like this for us ever before. I mean, this was line by line item guidance for each of the different subdivisions at Disney, whether, it was the theme park business or the streaming or movie studios. They kind of gave us, segment by segment numbers and exactly what to expect. And really the biggest thing for Disney over the past few quarters has just been this lack of visibility and so much of investor uncertainty. And they just cleared it all up in this one, fell swoop with this earnings report.
They never did that for me, Geetha. I always had to guess on all that stuff. But for you, they just served it up on a silver platter. What got your attention the most from some of this guidance? What do you think the street really likes?
I think what the street really likes is you have high single-digit EPS growth. Remember, the street was projecting about 4 to 5%. So that's a nice uptick there for 2025. And then going into 2026 and 2027, they're looking at double-digit earnings growth. And the other bright spots were, the theme park business. Now, we do know that there is a moderation when it comes to the domestic theme park business, but it looks like things might not be actually as bad as we had feared. So domestic parks actually performed a little bit better than we expected. And then they talked about some weakness going into the fiscal first quarter. Remember, we did have those two big hurricanes in Florida. They do have a lot of cruise ships that they're launching, and so there's going to be some launch costs weighing on profit. But then you get into the second half of fiscal 2025, and they're expecting those cruise ships to contribute in a big way and kind of the theme parks to also come back. So I think that's, again, some source of, investor optimism and confidence.
Geetha, I get the streaming part. I'm not sure that I understand the linear TV part and why that's still part of the empire.
Yeah, nobody understands it, John. And that was actually a question for Hugh Johnston and Bob Iger today at the earnings call. They're like, why should you be holding on to this business? Comcast just recently said that they're going to be kind of considering spinning off their cable TV network business. And remember, the big thing that's really coming up for Disney in 2025 is that they are launching this standalone ESPN product. And if they had any reservations in the past about jettisoning, the TV networks business because they were tied to the bundle through ESPN, this kind of definitely opens up the field for them, and it no longer ties them down to the bundle. So they were asked the question. They said that they're not looking into it. They like their portfolio just the way it is. But we really think that once they get that ESPN standalone streaming service up and running, they surely will kind of look into doing something more dramatic, I think, with the TV networks, especially given, a regulatory change.
Geetha, talk to us about the streaming business. They've finally turned profitable on that business. Give us the delta that you think that streaming business go to from losses to potential profits here.
Big turnaround, Paul. And I mean, this was really the big story for 2024, to go from $4 billion in losses in 2022, $2.5 billion in losses in 2023, to finally squeaking out a profit here in 2024. And remember, they've just barely broken even, so about $150 million in profit. But the whole story is how they kind of build on that $150 million. So, Netflix this year is going to report about $10 billion in profit. And I think there's some encouraging commentary. So they already kind of guided. They gave us actually hard numbers for the streaming profit for both fiscal 2025 and 2026. So 2025, they said over $1 billion in profit. And in 2026, they actually gave us a margin number, double-digit margins. And remember, this is the big story. Everybody is chasing those 25% operating margins that Netflix has already achieved. And so Disney it looks like, I mean, they obviously have a lot of catching up to do, but they're closing in.
What's the Bob Iger story, the succession plan? Any more clarity on that?
Question.
Yeah. So the big news there, John, is that we will get, hopefully, a new successor named in 2026. Remember, by the end of 2026, Bob Iger has to leave, or at least he has said that he will leave. So we should get some clarity before that. There is James Gorman, who's kind of leading the effort, who's spearheading this whole search process. They have this recruiting agency that they're going, and they've kind of broadened the scope of the candidates. So it's not just the internal candidates, the section chiefs that they're considering. It looks like they've expanded that to include external candidates as well. And this is really a little bit of a departure for Disney, but maybe they do go external after all. Hugh Johnston, the new CFO, is also an external hire. So maybe they're finally looking outward and not just inward.
All right, Geetha, great stuff as always. Geetha Ranganathan, she covers all the media industry and all the companies there for Bloomberg Intelligence. Always. I wonder who hired her. Stock is up 8.3% today. It's up 23% year to date. A lot of folks are saying, hey, this thing is maybe breaking out. Now that they finally figured out profitability on their streaming business, that removes one of the the headwinds that have been leaning on this stock. We're going to have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks, well, seeing a little bit of a struggle following a post-election rally, but equities still near all-time highs. We have the S&P 500 running close to technically overbought levels. So let's start there. The S&P 500 down 0.2%, 14 points at 5,971. We have the Dow down 0.1%, 69 points at 43,889, and the Nasdaq down 0.3%, 65 points at 19,164. We head over to the two-year yield, 4.26%. That's down 2 basis points. The yield on the 10-year, 4.42%, and that's down 3 basis points. To commodities, we have Brent crude higher, up about 0.8% at $72 a barrel. WTI crude at $69 a barrel. Spot gold lower, $2,569 an ounce. Some luxury news. We have Tapestry. That's the owner of Coach, Kate Spade. They're planning to buy back $6.1 billion of bonds. It's sold to fund its now blocked purchase of Capri. That's the company behind Michael Kors, and that's after ending that deal due to antitrust pressures. We have Tapestry right now down, up about 11%, but Capri down 2%. And LVMH reshuffled its leadership, returning Bernard Arnault's son Alexandre to its Paris headquarters from Tiffany. LVMH shares in Paris up nearly 2%. And shares of Burberry, they're up about 18% in London. Its CEO announced a plan. They're going to overhaul the brand. It reported a 20% drop in comparable retail sales. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and John.
All right, Lisa Mateo, thank you so much. We appreciate that. John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We're live here on our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. John, Lisa was just talking about, some technicals on the S&P 500. So I typed in S&P 500, SPX index, and then I hit RSI for Relative Strength Index. And it kind of says, it got a nice little chart there, and it shows you, when you're at an index level of 70, maybe it's a little overbought. And if it's down at 30, maybe a little bit oversold. We're sitting here at 64.5, and we bounced, or we came off of that 70 level just a few days ago. So from a technical perspective, maybe a little bit in the short term, a little bit expensive.
But also 23 times projected earnings at this point. Maybe that's
But
the
John,
focus.
if you pull out the Magnificent Seven, it's only 18 times. So but let's see what the professionals are doing there. Margie Patel joins us. She's the senior portfolio manager at Allspring Global Investments. She's up there in Boston. Margie, you woke up a week ago today, a Republican in the White House, Republican in the Senate, and now we learned today Republican control of the House here. Your folks at Allspring, did you change your outlook at all for how you think about allocating capital?
No, I think we're still looking for continued economic growth, maybe more modest, say 1.5% to 2.5% in real growth. And we'll have to see if any of these plans that the Republicans have announced, how soon they will actually be enacted, how much of a positive they'll give to the real economy. The market's liked it so far, but we'll have to see. So we're leaning more towards modest growth, same themes as we've had all year.
Well, stocks don't operate in a bubble. How closely should we follow what's happening in the bond market as we look at equities?
Well, I think it's interesting because you've actually had the bond market, looking at treasuries, actually move up. The Fed made a cut of 50 basis points in the funds rate. And instead of bringing yields down, we had the 10-year treasury actually go up by 65 basis points. Today it's even higher, say around 4.4%. But I think with inflation, say 2.5% to 3%, I don't think a 4.5% yield on treasuries is really enough to be a negative or slow down economic growth. I think it's really a neutral factor. And maybe it says more, we have a huge supply of treasuries. And so that is really dragging down the relative relationships between, say, treasuries and stocks or high yield bonds or corporate bonds, making treasuries look relatively cheap just because there's too much supply.
Margie, in the equity side of the business here, if you believe the Republicans are going to be pro-growth, pro-economy, does that suggest that I can invest along those lines, maybe think about more economically sensitive stocks, be it industrials or maybe even energy?
Yeah, and actually, industrials have been leading the market all year, which to me had been telegraphing that the market is not worried about economic growth, or you wouldn't have seen a sector like industrials, besides tech, be so strong. And we've actually seen energy look like it's finally got a little bit of life here, whether that's in reaction to growth or prospective new rules relating to U.S. exploration and development. We'll have to see. But I think those are continuations. Industrials are one of the best sectors year to date. They look like that's going to continue next year.
Is any of this priced in right now, like a proposed 15% corporate tax rate?
No, I just think that if you look at how much the market has moved since the election, maybe we really need a breather. Plus, we pretty much finished with third quarter earnings, which once again were pretty good. Say earnings were up, say average about 9%. So that certainly supports higher stock levels through the fourth quarter. And really, December is always a good month for stock. So it looks like we may have some short-term wobbling here and then have a strong finish to the year.
Fixed income's actually back in the green here, just broadly defined, Margie, and the best performing sector in fixed income has been U.S. corporate high yield, like really outperforming. Where do you see opportunities in the credit markets?
Well, you know, that's been the trend. High yield was the best performer in 22 when the Fed began rates, 23, and so far year to date. And in fact, the yield spreads have actually narrowed as treasuries have backed up. So high yield bond prices have held firm, yields have held firm, while treasuries went up. So that's, for example, double Bs now yield less than 2 percentage points over the same maturity treasury. So that says to me the market is not worried about defaults. In fact, corporate defaults in high yield next year, 25, should probably be under 2%. So basically, you actually could see yield spreads narrow even from these historic narrow levels.
Well, what's the path ahead for the Fed? 25 at the December meeting and maybe a pause in January?
Well, that's what's priced in, but you know, you can see it really, the Fed's actions at the margin haven't had a lot of influence on the equity markets, or frankly on the economy as a whole. The economy's chugged along, and so I don't think the market will react to another 25 basis point. It's pretty much baked in, I think, for the outlook, and then the Fed taking a pause.
Margie, thank you so much for joining us. Really appreciate it. Always getting a chance to chat with you, Margie Patel. She's a senior portfolio manager at Allspring Global Investments up there in Boston. John, I know you look at this all the time as well, so I'll call it out. Bitcoin, we're down. We're sitting here just below $89,000 per token, up about 0.4% today. Earlier in the trading session, we were pushing up to $92,000 per token. It just ripped pre-election, right around $60,000 up to. Here we are at 90, and I know you're all.
If the Bitcoin investors, what percent actually know what the token represents or what it is?
I don't know the answer to that. I'm going to guess it's a relatively small number, but they are buying it and ripping it, and this thing is going. I'm going to go to Mike McGlone because he's the only guy that I feel like has a handle on all this stuff. He's a commodity strategist, which means he's an expert in like corn, soybeans, gold, copper, but somehow he's become an expert on Bitcoin.
Because it's a commodity too?
Well, I just think he's a smart guy and he saw an opportunity to become a leading voice in something that's super duper hot, and he certainly has been. So much so that he's gone down to the self-proclaimed crypto capital of the world, which is Miami Beach. Go figure. Mike McGlone joins us here. He covers all the commodities for Bloomberg Intelligence. Mike, what do you make of this trading here in Bitcoin? Is this just the animal spirits writ large?
Definitely the latter, Paul. And I always like how you start me out laughing. But the significance is with the ETF flows, there is massive flows in ETFs, and there has not been anywhere near those kind of flows in gold. So to put that in context, total ETFs tracking Bitcoin now are over $100 billion. At the end of last year, or at just less than 12 months ago, that was about $8 billion. So total inflows have been closer to $30 billion with the new ETFs coming on. And of course, the rest is appreciation, but they're massive inflows. And these aren't traders, these are investors. So the concept of the bottom line from a commodity standpoint, there is definable diminishing supply. We know that. And we definitely have increasing demand and adoption. And the facts changed when President Trump was elected. He was a big crypto skeptic and actually anti-crypto when he was president, and he completely flipped. So we got to go with the flow.
Hey, will you explain to me what the strategic Bitcoin stockpile is going to be?
First of all, I think the best word describes it is silly. So we're going to go in greater deficit to buy a highly speculative risk asset. And I think Mike Novogratz said it well. That's unlikely, but it helped him get elected. Bitcoin people love it. It helps fill their narrative for the bullish stance. But it's also an example of just massive speculative excesses. And yeah, it's kind of silly. I mean, strategic petroleum reserve, we don't really need anymore because we're a massive excess producer. We put that on when we are net importer. Now we're net exporter. But Bitcoin reserve, maybe it adds to our goal. But the key thing about that is in the book by Saifedean Ahmad called The Bitcoin Standard, he predicted this, that the central banks in the world would start holding gold. I think I read that in 2018. At first I thought it was silly. Now every day that goes by, it's like, yeah, it's fitting in as a decent competitor to gold. It's digital gold. So maybe at some point the Federal Reserve will hold some, but we do have some central banks in the world who have already started allocating a little bit to it.
What is Tether, and why should we pay attention to it?
It's the #1 traded crypto, and I'm glad you mentioned it, Paul. It's the U.S. dollar. It's a token that tracks the U.S. dollar. It's running right now, and on a normal day, its volume doubles the volume of Bitcoin. And this is things I've enjoyed pointing out for at least 6 years when I first went to Hong Kong, and I got the sense of how significant Tether was back in 2018. Right then it was about 2 billion. Now it's 126 billion. It's just the ability to access, trade, and transact in U.S. dollars via a token with virtually no slippage. Like, and the typical Visa flipped over to using crypto dollars a little while ago when they realized, we can't transact dollars every day of the week, but tokens track the dollar we can. So it's a key thing I like to point about the technology. Technology has happened, and this has happened organically. The whole space in the world has gone to Tether as the most widely traded crypto, and it's the U.S. dollar. And now our regulators and leaders and legislators are figuring it out, and it's delightful to see that Bloomberg Intelligence pointed this out 5 years ago.
What's the case for gold at 3,000 an ounce?
A matter of time, John, particularly when you look what's happening in China. There is a structural decoupling in the U.S. from China. That's not my statement. That's Trump's statement from years ago, and that's a statement from the book from Robert Lighthizer, No Trade is Free. And it's just a matter of time. But it's what happened with the unlimited friendship between President Xi and President Putin shifted the world order that's really favorable to gold, any way they can get away from the dollar. So to me, it's a matter of time unless there's some significant détente. But the deepest pockets on the planet are buying gold, and that's central banks. Now, we've had a little speculative excesses. It got a little expensive around 2,800. But right now, it's bumping into good support around 25, 2,400, and I think it's more likely to head higher. And the #1 thing to make gold go higher, I think, in the future is if someday we get a little back and fill in the U.S. stock market, because that still is the main game, and the main game to be playing is the U.S. stock market's strong performance. It kind of pushes gold to the wayside. So if it starts backing up a little bit, gold will shine a little more.
Mike McGlone, senior commodity strategist, folks, for Bloomberg Intelligence. He's down there in the self-proclaimed crypto capital of Miami Beach. He went down there like 15 seconds after the pandemic started. He said, I'm out of here.
Mike was ahead of the curve.
I'm dumping all this Connecticut real estate. I'm going down to Miami. And he was like ahead of the curve big time. So that's the way he rolls. And he's now our expert down there in Miami, holding court down there. S&P 500 off about 6 points here. The Dow's off 15 points. The Nasdaq's off 34 points. Not a lot of movement at the index level for sure. 10-year Treasury yields pull back just slightly. We're now at 4.42. And we'll call out WTI crude oil sitting right at $69 per barrel. Bitcoin, it's up about 0.1%, just below $89,000 per token. We're going to have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Well, is it buyer exhaustion? Little movement in stocks this morning after an active post-election rally. It comes ahead of Fed Chair Jay Powell's speech this afternoon and after more economic data. We're talking about U.S. producer prices peaked up in October. And as well, applications for unemployment benefits. They fell to the lowest level since May. So we have the NASDAQ down about 0.1%, 21 points at 19,209. The Dow, little changed, up 15 points at 43,973. And the S&P 500, little change, down 2 points at 5,982. The two-year yield at 4.27%. That's little change. The yield on the 10-year, 4.43%. And that's down 1 basis point. We have shares of Cisco Systems. They're lower, down about 2% after a conservative annual forecast. And ASML Holding, those shares higher. ADR's up 5%. It's a Dutch maker of advanced chip-making machines. It reaffirmed its bullish 2030 outlook thanks to strong AI demand. And finally, Meta getting its first ever penalty for EU antitrust violations. It was hit with an $841 million fine. That was for tying its Facebook marketplace service to its social network. Meta does plan to appeal that decision. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and John.
All right, Lisa Mateo, thank you so much. We appreciate that. John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast, and that's where you will find us. Question is, what would you like to hear about on Bloomberg Radio? Hell, make shows like ours even better by taking our Bloomberg Audience Survey. Visit youtube.com/Bloomberg Podcast and click the link in our profile or community section to take the survey, which is hosted by our partners over at Material. Fill it out now at youtube.com/podcast. Lisa was just reporting that our good friends Meta fined 798 million euros, 840 million US dollars, by the European Union over classified ads dominance. I look at the stock, unched on the day, no real change. It's up 60% year to date, so I'm kind of thinking it's not that big a deal, but let's go to an expert on that. Mandeep Singh, Senior Tech Analyst for Bloomberg Intelligence, joins us here in our Bloomberg Interactive Broker Studio because he remembers the way to New York City, unlike his managers. Mandeep, thank you so much for joining us here. What does it mean for Meta here?
I mean, this could be a harbinger of more fines simply because even though this particular fine is like 0.5% of their total revenue, so really not a big deal. But in the grand scheme of things, what the EU is doing is saying their Digital Markets Act, which really prevents the gatekeeper companies, and Meta is deemed as a gatekeeper along with Alphabet and Microsoft and Amazon and Apple. These companies can give preferential treatment to their services. So in this case, Meta was fined because they show you ads on Facebook Marketplace when people are browsing their social media platform. And one could argue, you know, I mean, they do it because they have this marketplace, it fits well, it improves the user experience, but clearly EU doesn't want that to happen, especially with these gatekeeper platforms. And the same logic applies, you know, with Apple giving preference to their Safari browser or their maps, or Alphabet giving preference to their maps or flights product. So that's the kind of the really the focus that EU regulations have when it comes to these gatekeeper companies, and we'll probably see more fines in our view.
How many regulatory speed bumps are there out there for the digital ad business? It just seems to generate all this work for regulators.
I mean, there are two ways to look at it. One is clearly there are, you know, so many kind of regulations that are focused on these companies, the ad businesses that generates, you know, $150 billion plus in the case of Meta, in the case of Alphabet, over $200 billion. So clearly the focus is on the scale here. But the other side of it is it actually prevents more competition. Because why would an Oracle or some other tech company get into an ads business where you are at the risk of paying over $1 billion fines? Like, it's just not worth it anymore, you know, because of the scale of fines. I mean, $840 million, it's a lot of money. but it's not a lot for a company that's generating over $150 billion in revenue. So that's where I do think it has an unintended consequence in terms of limiting competition. But at the same time, I mean, it's very clear what the EU wants to do is they want more third-party products. Apple can't just say you have to use Safari browser. They want more choice screens. So that's the same concept that's applicable to all these gatekeeper companies.
I don't know. I was back in the day when Microsoft was getting fined by the European Union 25 years ago. How did that work out? I mean, Microsoft's a beast.
Yeah, well, all these companies have to make some remedies. That's what Microsoft did, is you can't just bundle, Internet Explorer with everything and be able to get away with it. So I think there are some things that they can do on their own, but clearly when it comes to paying these fines, and the fines could range anywhere from, low single digit to high single digit of their global revenue. So in the case of Meta, the fines could be as big as $10 billion. I wouldn't be surprised if it keeps happening and EU thinks they're not in compliance. We're talking about potentially a $10 billion fine here.
The regulatory lineup is changing in Europe, right? The faces, and in the United States, does it matter that might be going toward regulatory light?
I don't know for Meta and Alphabet, it'll be regulatory light, given a lot of these antitrust cases were started in Trump's first term. So, and there is no indication whatsoever that says, these companies are likely to get away with it. I mean, we know the stance of Vice President-elect J.D. Vance in terms of what he thinks about the big tech companies. So I don't think the regulatory scrutiny is going away anytime soon.
But here's the big wild card, I think, which is Elon Musk. We had Dan Ives on from Wedbush Securities on, and he says, as it relates to electric vehicles, he thinks this could really accelerate electric vehicles adoption. But it's, the conflict of interest, who knows? They'll figure it out, I guess. But he could be positive for big tech.
It could be. I think on the electric vehicle side or robo-taxis, probably lesser regulation. But when it comes to these giant ad businesses, I think that's where every regulator kind of agrees upon the fact that these companies have too much power when it comes to the ad revenue and the dollars they generate.
I know this is just tangential, but Tim O'Brien's coming up, and I wanted to ask him that question about Elon Musk.
Yeah.
Elon generates right now a little more attention than his good buddy, the president-elect. And you got to wonder how that's going to play into the dynamics going forward.
Yeah, that's going to be amazing. What are the tech, have the tech companies said anything about this election here? Have we heard anything from the Tim Cooks of the world or anybody else there about this election?
I think, again, our view is out of the Mag 7, probably Alphabet and Meta will have to contend with more scrutiny than the rest of the Mag 7, simply because I think Apple has done a good job when it comes to building the relationship with Trump and Amazon as well. So in this case, clearly, you're going to see more pressure on Alphabet and Meta.
What's the big story that you're following right now? What really captures your attention in this space?
Look, when it comes to the Trump administration, tariffs is a big deal. What sort of export restrictions will come into play, given everyone is so focused on AI, and what impact does that have on the development and the pace of AI? That, to me, is the biggest thing out there.
Mandeep Singh, one of the best. We appreciate it. Mandeep Singh, he's a senior technology analyst. He kind of runs all of our technology research on a global scale because technology is a global business. Obviously, Asia is a huge part of that, and we have a big team in Asia covering the companies there. We've got folks in Europe as well, but it's kind of run right out of here from New York with Mandeep Singh, Anurag Rana doing it all. And so technology, big issue here. Again, Meta, fined by the European Union, 798 million euros, about 840 million US dollars, over the classified ads dominance that it has. So we'll have to see how these companies navigate, as John Tucker was saying, a number of headwinds, regulatory headwinds, both here in the US and in Europe. Looking at the NASDAQ, speaking of tech companies, it's off just about 11 points here. So at the index level, there's no real movement here today, one way or the other. Taking a little bit of a breather from that big risk on trade that we saw coming after the elections last week. 10-year Treasury yields come in just slightly as well, 4.41% on your 10-year U.S. Treasury bond. A little more coming up. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, we got John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast, and that's where you find us. Joe Weisenthal, Tracy Alloway, Odd Lots podcast hosts. They're in our studio. John, we usually talk with Joe and Tracy. Big, weighty issues. Today,
well, this is big and weighty.
This could be big and weighty. Chickens, the chicken industry. Do you think of the chicken industry often, John?
I love chicken.
I love chicken.
Everyone loves chicken. It's so good.
Who doesn't? But
I get the chicken roasters at the food town.
Do you?
Oh, delicious.
There you go.
But you know what? It ain't cheap.
It ain't cheap. It didn't. You know, it's a big business behind there. Tracy, Joe, thanks so much for joining us here in our studio. Tracy, talk to us about how you guys look at the U.S. economy through the medium of chicken.
Yeah, that's right. So we're releasing a 3-part series called Beat Capitalism, and it's all about chicken and what it says about the structure and nature of the U.S. economy and things like consumer demand and inflation, also the labor market and how we structure that, and then finally how we think about the power of companies more broadly. And the weird thing about this series is, I guess it sounds a little bit random for us to be doing a whole thing on chicken, but like 80% of the guests that we have on in this series have already been on Odd Lots before talking. So it seemed like a natural fit for us to do.
There's so much there. in terms of looking at one thing that people consume in myriad ways, chicken, and then going back and figuring out how many interesting, I guess I would say macro questions that you can start to pick at from just looking at how you get from an egg to a bird. So, there's the question of just how pricing power works at the retail level. There's obviously, as Tracy was talking about, market competition and the degree to which a handful of large, massive poultry companies are this huge, dominant player in the supply chain. There's labor issues, which is, we think of like Uber and we think about gig workers. A lot of chicken is essentially grown the same way, technically independent contractors growing birds in their own farms, et cetera. There's the pandemic and the health-related issues when thinking about bird flu and the effect that that had on egg prices, which were so salient. And then egg prices had a effect on how people perceived inflation. So there's almost no topic in the U.S. economy over the last several years that on some level can't be understood by this one specific supply chain.
And it's not that the small producers were taken over by the big guys. They just couldn't afford to compete alone anymore.
Yeah, what it is, it's actually really interesting, the chicken labor market. So you have these sort of small scale chicken producers, but they're all contracted out to big, they call them integrators. So think about companies like Tyson or Purdue. And Tyson will give you the baby chicks, then you are responsible for raising them. But Tyson also gives you the food, they give you the medicines, they tell you exactly how you have to raise your chickens, but you as the farmer are taking on basically all the risk of actually doing that. So if Tyson says, we want a better barn for those chickens, you have to build it. And that's pretty costly. And it kind of fits into a broader criticism of the economy right now, which is we have these really large, powerful companies that are dictating terms, not just on the pricing side, but potentially on the labor side as well. And we also have more and more money being made by intermediaries. And we spoke to one person from the DOJ. She calls it the tyranny of the intermediary in this economy.
I'm looking at Tyson's, the stock. This is a big company. It's $23 billion of market cap nearly. Stock's up 18% year to date. Joe, is the chicken business a good business?
Yeah. I mean, so you're looking at Tyson, but, look at a stock like Wingstop.
Okay.
And that's, I don't know what it's done over the last few months. I haven't pulled it up in a while. But, I mean, that's one of the most extraordinary long-term stocks you'll see on the market. It's a fantastic business. One of the things that we get into as well on this episode is, the McNugget, right? It's just this like chunk. They're delicious. There are various versions of some sort of part of the chicken meat, then deep fried. Everybody loves it in sandwiches. But this is the emergence of an industrial process that emerged over time, right? Because at some point, as chickens were grown in the backyard and the meat wasn't really that good, et cetera. And then science came to the rescue, made the birds bigger, made them fatter, made them juicier, made them tastier. It found ways to process that meat such that we can get a chicken tender or a chicken finger or a McNugget, et cetera. So there's also this sort of long-term march of science story as the chicken has become a more wonderful food to eat in various forms and flavors.
And real quick, Trace, I thought we had regulators who watched over this thing and made sure there's competition, especially that the small business owner guy raising chickens wasn't going to get crushed.
That's an excellent point. They've done some stuff. So they have done some things to sort of crack down on the integrators and the terms that they can dictate to small-scale farmers. So for instance, if you are a small-scale farmer and you want to switch your integrator, you want to work with another big company, they used to punish you. They could penalize you for doing that, charge you money. The DOJ has cracked down on that. But, there's clearly a lot more to do here. And it's interesting, one of the approaches the DOJ is taking now, again, going back to that intermediary point, they're not necessarily looking at Tyson and Purdue, although they tried previously, but they're looking at a company like AgriStats. Have you ever heard of that one?
Never, but I'm sure it controls my life in some way.
Yes. It's a pricing database for groceries, basically. So if you are selling a grocery product, this company will tell you what it thinks you can sell that for. And you can guess what effect that has on the market. So there's currently a suit going through on AgriStats.
All right, Tracy, great stuff. Great story. Tracy Alloway, Joe Weisenthal, Odd Lots podcast host, joining us here in our Bloomberg Interactive Broker. They've got a 3-part podcast coming out Beak, B-E-A-K, Beak Capitalism, talking about looking at some of the issues in the U.S. economy through the medium of chicken. Who doesn't like a good chicken sandwich? We're going to have more coming up. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Norma Linda. She's going to give us the latest on what's happening in the stock market here. She covers the stocks for Bloomberg News. Tim O'Brien, Bloomberg Opinion Senior Executive Editor, can give us his thoughts on some of these, the appointments for President-elect Trump to his cabinet. Some czars being named as well, so we'll get the lowdown there. Barry Ritholtz is going to join us. Why? Because it's Thursday, and we always talk to Barry Ritholtz, founder of Ritholtz Wealth Management and host of Masters in Business podcast. Jason Kelly, Bloomberg Originals chief correspondent, on the latest episode of his podcast, The Deal, with Alex Rodriguez and Jason Kelly. They always talk to some really interesting people, so we'll talk to Jason and get the lowdown there. But right now, let's get a Bloomberg Business Flash with Charlie Pellet.
Hi, thank you very much. And here's what's going on. Stocks lower. This Bloomberg Business Flash.